Welcome to Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brooke DePalma. We are getting the CPI numbers now. They're coming in right in line with estimated consumer price index, rising 0.4% month over month. That is a reacceleration from the prior month. It's also in line with estimates ex food and energy. We're getting the same increase, 0.4% year over year, a 4.9% gain ex food and energy. That number is 5.5%. So again here, headline inflation reaccelerating in April compared with March. This wasn't entirely unexpected on the part of economists. In fact, it was exactly what they expected in terms of the overall numbers here. One of the reasons why is that we had seen shelter costs abate in the month of March, and some economists had said that that was just a one-off and that we were going to see that reacceleration. If you look at the longer-term trend here, what we are seeing is an overall deceleration. Yes, even though inflation sped up again in April, if you look over the past 3-month or 6-month trend, you do see a slowing in the rate of inflation. It doesn't mean prices aren't going up anymore.
Right.
They are.
Right.
They're just going up at a slower pace, which is good news for many Americans and good news for the Federal Reserve, which of course has been trying to fight inflation.
Yeah, and some of those core necessities categories, and thinking primarily in some of the energy spaces as well, a lot of people will be pleased to hear at least some of the month-over-month figures that we've continued to track here for gasoline and fuel oil. You did see in fuel oil at least a move lower by about 4.5%. Energy services, that moved lower by about 1.7%. It looks like with the utilities, particularly gas services, that down by about 4.9. And then additionally here, kind of looking through some of the other figures here, as we talk so much about medical care, it's interesting to see that that's still moving higher, but just barely here. And I think the headline there is that it's not moving higher as much as it was previously. I mean, you think back to January of 2023, where that moved higher by about 1.1%. At least in this most recent month, looks like it only moved higher by about 0.5%.
Well, it's interesting. That's medical care commodities.
Medical care.
So that's stuff that you buy for medical care. Medical
Right.
care services actually continue to trend lower, which
Right.
so that's an interesting dichotomy. And part of that probably has to do with the bounce back from supply chain disruptions. So that's still elevating medical care costs for stuff, even as services are going down. Brooke, I know that you are focusing on the food side of the equation. What stands out to you?
Right. Well, food at home, unadjusted, up 7.1%, month over month, up 0.1%. And something that we've been following closely is, in fact, eggs. Some people, some experts on the street really warning of a deflationary egg crisis, of that price coming down too fast because of ample supplies and lower demand. Right now, month over month, though, we're seeing just a decrease of 1.5%. Now, eggs largely volatile here, and so it's something that we'll continue to watch. But that number a bit less than I expected. I know that last month, eggs month over month decreased 10.9%. So this just a slight decrease month over month. But in addition to that, we've also been following California, as that wet weather certainly took a toll in the end of March, early April. We see citrus fruits month over month down 2.7%. In addition to overall fruits and vegetables down 0.5%. And largely we're seeing numbers as far as groceries go down month over month. But as noted in many earnings calls, we are seeing beef continue to be a sticky point for inflation. Beef and veal up 0.3% month over month, but largely numbers down, which is definitely encouraging for both Wall Street and Main Street.
Yeah. One additional figure that I'm continuing to really look through. I mean, you guys know I love to talk about airlines here, and as a lot of people are planning summer travel, and the CEOs that we speak with here on Yahoo Finance have continued to talk about a counter-cyclical recovery or a resurgence in travel demand that's remaining strong. It's interesting. Among the indexes that are tracked by the BLX, several indexes declined in April, actually led by airline fares. That index fell 2.6% over the month after rising in both February and March. So that gives you a little bit of the inclination into how the market, how consumers are digesting some of the airline fares right now, and perhaps where they're pushing back and where that's causing some of the airline operators to also say, you know what, all right, we got to be a little bit more responsive to where the appetite to pay is right now.
And one final note, as we're talking about the different components, used vehicles up 4.4%. So that is a reversal. We had seen some comeback and down. New vehicles, though, seeing a little bit of a decline. All right, we're going to leave it there. We'll have much more, though, on CPI coming up at 9 a.m. and much more. This is Yahoo Finance Live.
Papa John's growth stalled in the first quarter as the pizza chain faced high food and labor costs and battled with third-party delivery platforms, but the company continues to lean on menu innovations to drive in customers, most recently joining forces with PepsiCo to launch a new Doritos Cool Ranch menu item. Joining us now to talk the business of pizza is Papa John's CEO Robert Lynch alongside Yahoo Finance's Brian Sozzi. Okay, Robert, I mean, since we mentioned it, I just have to ask, what prompted the Doritos pizza?
Well, it's a papadilla, which is our handheld item, right? So it actually is shaped kind of like a Dorito. And I think, that might have spurred some inspiration with our culinary team. I think the other thing is, our strategic focus about going after a little bit of a younger demographic. Doritos brings in a new kind of core customer for us, 18 to 25-year-old males who, love Doritos, have loved Doritos for years. And we think this is a perfect marriage of our great brand with another great brand from Frito-Lay.
Rob, PepsiCo, well, good to see you. PepsiCo has a lot of different flavors in that Frito-Lay portfolio. Is this a sign of things to come?
Yeah, I mean, we're always looking for great ideas and great innovation. And we believe that innovation and ideas can come from everywhere, whether it's our culinary team, our restaurants, or from our strategic partners like PepsiCo. So, we've been, delivering great new products for the last 3.5 years. Stuffed crust, New York style pizza, garlic Parmesan pizza. All of these things are new to our brand and new to our customers. This is just the latest in that, but it's one of our biggest. We've put more support behind this. We think it's a platform that we can continue to grow off of. So that's what we're focused on right now.
Rob, I've been following your CEO journey at Papa John's literally since day one. And we talked that day you got announced as CEO. Where are you at in the turnaround of this company?
Yeah, I think we've definitely turned around this company. We've gone from about 850 to 900,000 per year sales per unit. And today our system average is almost 1.2. Our franchisees are healthy. Our franchisees are developing. The last couple of years have been two of the best years in the company's history. Obviously, over the last 9 to 12 months, we've had some challenges on the cost side with the global macroeconomic environment, but our customers have stuck with us. All those sales that we drove during the pandemic have stuck with us. We've, last year we were the only global pizza company to deliver positive comps in North America. So even Q1, we're really proud with Q1. We lapped over a quarter last year that had kind of the last fight of the COVID pandemic. Omicron was in January of last year, so we had a really big lap in January, and we've continued to sequentially improve since then. So we're excited about 2023 and beyond.
Rob, I'll be real with you. I was out of the customer base with Papa John's for a while, and after the John Schnatter events came to light, however, had the opportunity to speak with Shaquille O'Neal, who is still on the board of Papa John's and got on the board as a result of an investment. I wonder, for the other consumers like myself who may have taken themselves out of the equation for a while, what you're doing to win them back.
Well, we're trying to be a company and a brand that we can all be proud of. This is the third straight year we've been named one of Forbes magazine's top employers for diversity. I mean, think about that journey from where we started and what you're referring to where we are today. And, when I interviewed for this job, I met with Shaq. And he told me, Rob, I really want you to come here on this journey with me because we're going to do some really amazing things, not just from a business standpoint, but from a company standpoint, from a people standpoint, from a culture standpoint. And I fundamentally believe that we've achieved that. Obviously, it's a never-ending journey. We can always get better, but the progress we've made, there's a lot of pride back at Papa John's, both with our employees and our customers.
Rob, that's good to hear. I know that's been a focus by you and the team for sure. Let's go overseas a little bit because you have also now started to push into India or looking to eye a push into India. Now, it didn't work in the past prior to your arrival. What are you doing now to ensure that does work, and how big could that market get for you?
Yeah, it's a huge market. I mean, 650 restaurants committed over the next 10 years. That's a really big number, 65 new units per year on average. And so what we've done differently is we've been more strategic about this entry into this marketplace. We picked the right franchisee in PJP, who's been an amazing partner for us in the Middle East for the last 5 years. They run and operate 100 great restaurants in the UAE, Jordan, and throughout that region. And, we fundamentally believe they're the right partner. And we've worked with them for the last year and a half to build the business model to go in there from a supply chain standpoint, from a penetration standpoint. The last time that Papa John's went into India, it was before my time, was kind of a scattered approach. They went into multiple markets. They kind of tried to take the model that had been planted everywhere else and just kind of bring it into India. India is a unique market, has different price sensitivity, has different components of the business model there. Our team worked with our franchisee team to build a lot of insights and knowledge into how we launch there. So we're going to go market by market, penetrate a market, build a foundation there, and then expand. So that's a little bit different than how we approached it the last time.
Rob, we've heard some companies call this year a year of efficiency. Some of them call it a year of rebuilding. What would you call this year? What would you frame this year as for Papa John's?
This is a year of growth for us. Last year was a challenging year for Papa John's. Once again, we were able to deliver positive comps, but we made less money last year than we did the year before because of the inflation. We own a lot of restaurants. We've been hit by the wage inflation in our own company restaurants. So we're kind of in the trenches with our franchisees on the commodity inflation and the labor inflation that they're facing. But we've built a model now that is set up to deliver great margins on top of the great revenue that we're going to generate this year. We're really bullish on some of the innovation we have. Doritos Papadilla is just the kind of the first foray into some of the great items that we're going to be launching this year. So if we can continue to hold on to those customers and drive top line revenue growth, we're going to see some margin enhancement through some of the commodity deflation that we're already starting to experience.
Rob, real quick before I let you go, are you using AI at all to better customize the orders on your app? You have over 30 million rewards program members? That's huge. Are you using this technology anywhere?
Yeah, I think we've just scratched the surface. I think that it's an opportunity for us. We got to be careful with it. We got to make sure that we're doing it the right way. But driving, insights out of our analytics is a big opportunity for us to get better and drive more frequency. As you mentioned, Brian, almost 30 million, customers in our loyalty program. We get all their first-party purchase data. I mean, they've opted in to allow us to get that data so that we can better meet their needs. And I think we have a big opportunity to do that. And that's going to be a key differentiator for us from the rest of the restaurant industry. Pizza, order ahead, different behavior, different level of data that we need to make sure we're taking advantage of.
Really good conversation here today, Rob. Really appreciate the time as well here, breaking down some of the quarter results as well as the future pathway for Papa John's here as well. Robert Lynch, Papa John's CEO, as well as our own Brian Sozzi. Thanks so much.
Thank you for having me.
Well, this story will no doubt dominate U.S. media this evening. Joining us to help untangle it all is Steve Schmidt, political strategist and founder of the Warning newsletter, YouTube channel and podcast. He's known for having worked on various high-profile campaigns, including those of George W. Bush, the late Senator John McCain, and former Governor of California, Arnold Schwarzenegger. Thank you for joining us this morning. So, as we were saying, we've been here before in 2011. This does have a different bit of a feel to it in terms of perhaps the credibility of letting it get right to the brink and perhaps maybe over the brink. What are your takeaways at this point?
Well, you should think about this like walking out onto thin ice 7 days a week every year of winter. One day, eventually, you'll fall through the ice. And so fundamentally, this White House meeting, what we're seeing is Mitch McConnell's taken the position of this is between Kevin McCarthy and President Biden. We all saw what happened during Kevin McCarthy's leadership votes. We should expect the same type of chaos inside the caucus, the Republican MAGA caucus. But essentially what McCarthy is doing is holding a gun to the head of the American economy by refusing to pay for the spending that he, Kevin McCarthy, and the Republicans, particularly during the Trump era, ran up. And so from the beginning of the American Republic, one of the safest bets in all of the world has been that the United States pays its debts. Should the United States default, this will have a cataclysmic effect for the American economy, the global economy, and America's political standing in the world. But what this is at the core is a political crisis manufactured fully and wholly by America's politicians who are threatening the prosperity of the American citizens who they work for. And it is a real threat.
So given how much is at stake, though, what are we expecting in terms of outcomes from this initial meeting? Because neither side wants to back down.
Well, there aren't two legitimate sides to this. And I think that's important to understand, which is foundational to the White House position, which is the raising of the debt limit speaks to the spending that has already happened. Now, the size of the American debt is something to be worried about. The size of government spending is an important debate to have, but that's not what this debate is about. This debate is about paying the bill on the spending already done, and that's the thing. There are no small government parties in the United States anymore. Both parties are profligate, and both parties are spending at a level that will take the country to the edge fiscally of oblivion at some point. But regardless of that long-term debate, this issue is about maintaining the full faith of credit of the United States, and the threats to obliterate it are an act of political vandalism, not a policy difference. And so the hijacker isn't in a real estate dispute with you. They're hijacking, they're taking something. And so we have a hijacking situation with the American and global economy. We've seen this play out now as kabuki for many years, but in this instance, this moment, and this train track has been clear as day since Kevin McCarthy became Speaker in January. We're headed to a very dangerous moment where there's very little evidence that these people are able to resolve big, complicated tangles that they have made for themselves.
So then as we try and look for what could be the tipping point here, I mean, as we look at Wall Street at the moment, it's more focused on the inflation fight than anything else. But as we get closer and closer to this date, could be June 1st, according to Janet Yellen, could be perhaps several weeks after, some analysts put it, in July. Without really seeing any sort of market reaction to this, can we expect any sort of other tipping points between now and then?
There's only one consideration. I think that one of the Wall Street reactions is Wall Street tries to look for some rationality in all of this, tries to make a prediction. There is no rationality in this. And that's what's broken about American politics. It's become detached from rationality. So as this moves forward and moves closer to the line, the only consideration that will truly matter from a negotiating position on Kevin McCarthy's, is there a backlash in the country from the American people among key constituencies that he assesses is necessary for the purposes of maintaining his majority. If he believes that he can advance forward without harm being done to that, then the chances of a default happening increase exponentially.
I mean, and when you have that sort of laser focus, not just on Kevin McCarthy's position, President Biden coming in with a 36% approval rating, according to the Washington Post ABC poll, there's a lot to lose here. And there's also going to be a lot of blame to go around if this doesn't get put through. But who do you think is actually in a worse position here? If you're, looking from Main Street versus Wall Street and looking at this, where does the blame actually end up lying?
There is no American who is in worse position with regard to this than your middle income working family. That's who pays the price. That's who gets hurt. The average American, the 40% of the country that doesn't have $400 cash available. This will do significant damage to America's standing in the world, to the status of the dollar as the world's reserve currency. It has enormous geopolitical implications. And every American leader from the beginning of the country through the generations has understood the absolute necessity of this country paying its debts. Now, part of the brokenness is the stupidity of the era, the inability to have a serious conversation, a complex conversation about anything. And again, government spending, the $30 trillion American debt, these are all legitimate and necessary issues, and it is good that they should be debated. But you don't debate these issues by refusing to pay the bills on the money that was already recklessly spent, that has the effect of beggaring future generations of Americans. So the magnitude of this as an economic crisis is significant. But in the end, the consequences of this will be politically disastrous and further undermine the faith of the American people in democracy as they see the brokenness that has resulted from these two political parties that are unable to put the interests of the country and the American people ahead of whatever posture they're in and whatever fight of the moment that has nothing to do with the long-term peace, prosperity, and the pursuit of happiness of the American people.
Which is all it should be coming down to. In the grand scheme of things, that's why we elect our leaders. A big thank you there to Steve Schmidt, political strategist and founder of the Warning newsletter, YouTube channel and podcast. Thank you for joining us on Yahoo Finance.
It is 9 a.m. here in New York City, and this is Yahoo Finance Live. Here are the three things you need to know this morning. Brad Smith here with Julie Hyman, and first and foremost, got to tell you about signs of slowing inflation. Consumer prices increased 4.9% during April from a year ago. That is the smallest 12-month rise for the headline figure since April of 2021 and the first reading below 5% in 2 years. Shelter was the biggest contributor to that number. The month-on-month figure landed at 0.4%, bang in line with estimates. The reading should offer some respite for investors out there, given ongoing confusion over the path of Fed policy. Markets are largely expecting the central bank to hold steady in June, though expectations for a hike haven't been taken off the table entirely. This could all change now, of course. No hospitality from investors as well this morning in our second thing that we're tracking for Airbnb. The inflation picture dampening the outlook for the company despite first quarter numbers that beat Wall Street expectations. The home sharing giant sees second quarter revenue between $2.35 and $2.45 billion. That would indicate the slowest pace of growth ever. The key metric, gross booking value, though, that came in at $20.4 billion. That's up 19% on the year. Like almost every other company reporting this season, it seems they touched on AI too, artificial intelligence, saying it plans to integrate it into the platform over the next year. We'll hear from CEO Brian Chesky later this morning. Don't miss that conversation. And third thing you need to know, no deal yet, but an 11th hour agreement on the debt ceiling could still come to pass. President Biden says he isn't taking a short-term deal off the table after a crunch meeting with congressional leaders failed to make any major breakthroughs. Markets now look to Friday and another meeting of the principal players, including House Speaker Kevin McCarthy. Treasury Secretary Janet Yellen has warned the so-called X date, when the federal government effectively runs out of borrowing capacity. That could come as early as June 1st.
Well, still high, but slowing. A better than feared inflation report likely to offer investors a tailwind on another busy day. April's headline figure grew at 4.9% on an annual basis, which is the smallest 12-month rise since April 2021. It's the first reading below 5% in 2 years. The core number, however, still holding tight at 5.5%. That's the key for Fed policy, also rising 0.4% on a month-over-month basis. Joining us now is Matt Miskin, John Hancock Investment Management Co-Chief Investment Strategist. Hey, Matt, good to see you. I'm looking at the stock reaction, which is actually pretty positive on this. I mean, I don't even know how to read this number at this point.
Well, it's like you said, it's better than feared.
Right.
If there's a tagline for 2023 so far in terms of markets, it's better than feared. It should be a bumper sticker. And this inflation report, the whisper number on it was more like 0.6. Goldman Sachs thought 0.5. Much of those that were looking at it thought that we're going to have a higher than an estimated inflation number, came right in line. And then there were some positive developments within it. Shelter is the biggest component. That was more like 0.4, down a little bit more relative to last month. But nonetheless, the housing market's going to be that key component. We're seeing some really tricky housing dynamics. The Midwest is doing pretty well. The West Coast isn't doing so well, but overall inflation is starting to subside, and that is good news.
Okay, and so within some of those core areas that you're tracking across this report, you know, as you were, I saw you in the green room, you were taking a bit of a quick but deep dive into some of those figures. You know, what jumps out to you right now as areas where inflation is still sticky, still needs to come down as well?
Yeah, I still think it's rents, housing that are still sticky. You know, you were talking about airlines in particular. That actually started to come down. Yeah. Some of these reopening trends that, you know, really took place relative to last year, that had been really driving some of the inflation. That's starting to come down. So that's been positive. The car market, you know, new cars, I think, was actually down a little bit. Used cars up a little bit. But overall, the trends are positive. It's that housing component, though, that has been the toughest one to bring down. Unfortunately, housing prices likely need to come down more to get to that 2% target of the Fed.
But of course, that's going to take time. It always does. Better than feared also feels like the sort of Fed vibe as well, you know, right? That the Fed is not going to have to be more aggressive. Does it also apply to the economy, that we are not going to see a recession?
I don't think so. So that's a great point. So what we're seeing here is all of this has been driven from peak in Fed funds expectations. The 2-year Treasury yield peaked really at the third quarter, fourth quarter of last year, started to come down, risk assets started to run. The dollar also peaked in the third quarter, fourth quarter last year. That started to come down because that's a reaction function of Fed policy. But the thing is, if the Fed really starts to cut, that's when a recession happens. Right now, we're in the pivot pause, like in the environment type period, but that can't last forever. We think the Fed could be done here, though. If that might have been the last rate hike of the cycle. And if that is the case, I think that is going to be buoying risk assets for the short term. It's just as you go later this year, I think they're going to actually have to cut. And if that's the case, you want bonds over stocks.
If the Fed is done, is that just rally on for the markets?
I think it's choppy. The economic data is going to come in and have to present itself to reaffirm even that pause. The NFIB small business optimism that came in yesterday wasn't that great. In fact, it was pretty bad. So you're still seeing this weakness undertone in the economic data. And if that overwhelms, kind of the Fed pause benefits right now, then that's going to be negative for risk assets.
One of the other risk factors out there that might not turn out better than feared is the debt ceiling. Equity markets don't seem to be too worried about it. Should they be?
Yes, short answer. I don't see it priced in. The VIX where it is, or high yield spreads tight.
But are they really not going to come to a deal when all is said and done?
I think there could be a point where they have to cut spending in the short term, meaning either furloughs or government spending has to be taken down to some degree.
So in other words, even if they come to an agreement, if that agreement includes spending cuts, that could be bad for markets?
Or if there's an air pocket there where they push this debate on and on and on, and they don't make a short-term resolution to just kick it down, then they're going to have to make some short-term spending cuts. The timing of this could not be worse. The Federal Reserve just went through its biggest tightening period since 1980. The economy is right on the brink, barely holding on here. And now the government is basically pushing this risk on the market. And again, I don't think it's priced in. But if there's any reduction in spending, any reduction in government support and just the economy, that is going to provide an air pocket. We do think it's a pretty big risk.
If there are spending cuts, if there are cuts more broadly that we have to kind of factor into the equation, then what sectors does that have the most risk for in this interim period then?
Yeah, so government spending in terms of government employees, I think it's just really the jobs report and keeping those people keeping their paychecks, because again, right now the jobs market has been the most powerful engine of this economy. Government spending, and it was actually a positive to Q1 GDP. If you remove that, Q1 GDP probably wasn't as positive. And again, Q2 GDP might not look as strong. So if you remove government spending and you potentially see people that have lost their paychecks for even a short period of time, again, timing of this could not be worse.
So let me guess, you guys like fixed income as a place to hide for all of this. I mean, this has been a consistent theme for you guys for quite some time, but the environment you're discussing, even though better than fear, like even though the backdrop is good, it does sound like an area where you at least want to have some defensive positioning.
That's exactly right. Yeah, and we've been talking about this for months now. And right now we're in this kind of, everything is just trading in these ranges. And it's the bulls don't win, the bears don't win. But in fixed income, you're getting paid about 5% in high quality investment grade bonds. While you wait, while everybody else fights it out in the markets, you're getting paid to wait. And then you could see, with a duration of 6 years, if the 10-year does come down, the 10-year Treasury yield usually drops 2.5% to 3% in a recession off the peak. That could put a one handle on the 10-year Treasury yield by the end of the year. The math on the bond market is that's double-digit return potential, and then you're getting paid 5%. I can't do the math on anything else cross-asset right now to suggest that much return potential. So I get the pops in parts of the market, the equities right now, but we would trim into runs and redeploy into high-quality fixed income.
We had Austin Goolsbee on the program here on Yahoo Finance saying that credit squeeze is beginning here. How does that continue to impact the regional banks that have already been so rattled in the equity markets and for some of them have seen their demise, unfortunately, as a result?
Right. We do see a lot of consolidation in regional banks where there's going to be acquisitions, M&A, to try to basically shore up any positive assets in that and bring it to other places. But at the end of the day, the broader theme is the lending growth is going to plummet. And we got through one report with a Q1 senior loan officer survey where it wasn't that bad, again, better than feared, but again, all these banks are going to be pulling back on loans because they're not going to feel like they have the deposits to be able to make all those loans. And if you pull that back, and mortgage rates are back up. credit card interest rates are high, auto interest rates are high. So the consumer's already getting hit with these high interest rates. But then if the bank's saying, I don't even want to give you the loan, then that pulls back even more economic activity. And that's that multiplier effect, that M2, that multiplier effect. If that comes down, again, it brings you into high quality bonds.
Matt Miskin, John Hancock, yes, right back into the thesis.
Consistency.
Yeah. Matt Miskin, John Hancock, Investment Management Co-Chief Investment Strategist. Matt, great to have you here on set with us. Thanks so much for the time this morning.
Thanks, Brad. Thanks, Julie.
Also, everyone, we're tracking shares of Airbnb this morning. They're plummeting in the pre-market, down 13% after the company delivered a cautious outlook for the year. It's warning growth would pale in comparison to 2022's strong performance here. And, really parse through some of the earnings call that took place last night, everything that was talked about from some of the elements of the summer 2023 release all the way into artificial intelligence and where that can be weaved in. But I think investors really just zeroing in here on where the growth is going to come from and at what type of average daily rate will the companies see that? And I think even in their projections, pointing out that the night's growth will be slower than some of the revenue growth that they're forecasting. That revenue growth for the second quarter, they guided for $2.35 billion to $2.45 billion there. And they're actually coming off of a period where they saw night's growth slightly lower here. And so for the market that is trying to, and for the consumers, I should say, that are trying to figure out where their pricing comparison is going to be best, and within those transparency pricing rollout that they had as well, it'll be interesting to see how effective that is in ultimately driving more of the reservations, the bookings, but also at what rate that comes in, especially as they just had a winter release that was prompting more hosts to put their rooms online and list online.
I mean, I think we would go from better than feared, which was our discussion that we were just having, to as good as it gets, right? It seems like because of that big surge that there was in 2022 in demand, that inevitably there is now going to be this slowdown, or maybe not inevitably. I mean, it does seem to have caught the street off guard that things were not still booming to the same extent. I mean, the company is still growing here. EBITDA is going to be about the same this quarter as it was last quarter, excluding costs. And that year over year, you're not going to have the same kind of growth. And it's just, comparables are really tough here. I was struck by the pricing. You were just talking about pricing. We were showing that on the screen that the average daily rate was $168. And what's going on there? Some of it's currency. People's willingness to pay is something that the company cited. In other words, maybe seeing a little bit of pushback on pricing, and a shift back to urban rentals, which I also thought was quite interesting because that's something that had obviously changed during the pandemic. And so all of those factors suggesting that, again, things were, that was as good as it got for at least a little while. Maybe, at some point you could clearly see a re-acceleration here, but for right now, it's just not a favorable comparison.
Yeah, one plus on the kind of resurgence, if you will, that is brewing within the urban rentals would also position them to have kind of a strong regulatory relationship within some of those cities that they were looking to have the ability to bring more rooms online. Because at the same time that you think about urban rentals, it's also where that's impacting the availability of low-income housing as well, especially if many people are just going to list on Airbnb. Typically, those buyers in that market are willing to spend up, knowing that it will be income that either can provide them a tax benefit or can just be a side piece of income, but then that impacts, of course, the residential market in those cities as well. So they do have a strong relationship, it seems, within some of those cities where that was in question before. But I think, even as we hear from Brian Chesky later on today, that's going to be something to really kind of speak a little bit more about, what they're doing within those communities to make sure that it's not dampening those markets so detrimentally. And also at the same time where this company is still trying to grow out as well, coming off of its first profitable first quarter.
Yeah. Well, as you mentioned, we're going to get our hands around that quarter and dive into Airbnb's earnings with CEO and founder Brian Chesky. Brad's going to be live for that interview at 11:50 a.m. You don't want to miss that to get more clarity on all of these issues we've been discussing. Meanwhile, no progress on a debt ceiling agreement after President Biden met with top congressional leaders yesterday in an attempt to strike a deal ahead of the looming deadline of June 1st. The impasse continues as President Biden pushes for a clean debt ceiling increase, no strings attached. But Republicans holding firm that the outcome would lead to extreme spending restraints. President Biden reiterated after yesterday's meeting that default is not an option. House Speaker Kevin McCarthy saying he did not see, though, quote, any new movement. The meeting showed little signs of forward progress, with officials set to meet again on Friday. And we're going to speak with a policy analyst later on in the show. We talked with Matt Miskin a little bit about this, but if a default happens, what gets trimmed back first? What effect does it have on you? We will be digging into all of that.
The big industrial slowdown. Maybe not. The largest manufacturing and construction companies should be battening down the hatches if a recession is on the way, but the story could be a little different this time around. One reason is President Biden's $1 trillion infrastructure law signed in 2021, and it made improving the nation's roads, ports, waterways, and airports a priority. So is this going to be a big enough boost for the sector and related industries like logistics? Yahoo Finance's Shauna Smith is at the Goldman Sachs Industrials and Materials Conference, speaking with leaders on what this current economic climate means for their businesses. She joins us now with Drew Wilkerson, who is the CEO of RXO. Shauna.
Thanks so much, Brad. Yes, I'm joined by Drew Wilkerson, the CEO of RXO Truck Brokerage Business. Drew, thanks so much for joining us here today.
Thanks so much for having me. It's great to be here this morning.
So lots of talk at this conference over the last day and a half about where we stand in the economy right now. We're in the midst of lots of talk about a freight recession. What are you seeing from your perspective?
Yeah, overall, it's a tough macro environment right now. If you look at what you're seeing in the transportation world, freight volumes are down as a whole. Now, for our business in the first quarter, we were actually able to grow volume by 6% on a year-over-year basis. We're able to do that because what you're seeing is customers, as their volumes are shrinking, they're consolidating their carrier base. So they're leaning into the partners that they trust the most, that have the best technology, and that have delivered results for them for a long time. So while it's a tough macro environment, we're still going out there and taking share, and we're doing that profitably.
Drew, last time you were on Yahoo Finance just a couple of months ago, you said that there were reasons to be optimistic about the second half of the year. It sounds like the business is trending in the right direction. Is that still the case?
So if you think about whenever I was on last quarter, one of the things that we talked about was customers were only, especially in retail and e-commerce, were only talking about destocking their inventory. Now they're talking about how their inventory is restocked, and we have to be able to get the orders out to the end consumers. We've seen strong trends in the technology and the healthcare verticals. So there are reasons for optimism as we look towards the back half of the year.
What are you seeing from some of your retail clients? I know some of your customers include Dollar Tree, Costco, just to name a few there. How are those conversations going, and what are you seeing as their needs, at least in the short term?
Yeah. Volume for retail and e-commerce for us is down on a year-over-year basis, but it is decelerating from where it was down in the fourth quarter, and we are starting to see those inventory levels at a more normalized state. So it's a little bit easier comps for us as we get into the back half of the year.
When we talk about pricing, obviously inflation, a big focal point for CEOs across the industries here, but for your business, we just got that print this morning, 4.9% year over year, slight improvement. How big of an impact has inflation had on RXO?
Yeah, so specifically in retail and e-commerce is where we saw volumes go down, and that inflation was a big driver there. As you talk about pricing, we've seen our contractual pricing go down anywhere from 10 to 15% on a year-over-year basis. And our spot pricing, meaning whenever carriers are rejecting tenders and they're coming out on spot boards, we've seen that pricing even fall below that. But one of the things that we've done to protect ourselves is we're also pulling down our cost of purchased transportation, which is how we were able to keep our margins flat on a year-over-year basis.
Drew, lots of talk, more macro speaking, about the showdown going on right now in D.C. over the debt ceiling. From your perspective as a CEO of RXO, how are you looking at uncertainty like that?
I think the one thing that we've learned over the last couple of years is that we've got to be agile and flexible and be able to adapt to all different types of markets. And we've been able to show that. We've shown that during the upturn during COVID, whenever you saw retail and e-commerce take off, that we were able to flex up our capacity and meet customers' demand. And is what you're seeing right now in a softer environment, we're not just holding on to what we're having, we're taking share and we're doing it forward, moving the ball forward. A lot of that is because of the technology that we put in place at RXO that is highly integrated with our customers.
One of your priorities here has been your investment in technology. Lots of buzz over the last several months about AI, a space that you have been involved now in for quite some time. How is your investment in AI? How does that position your company? What's the edge that it gives you?
Yeah, so we've been investing in AI for over a decade. And so if you think about the pricing algorithms that we've got that allow us to have best-in-class margins, it's because with every load that goes into the system, our algorithms get that much smarter on a pricing perspective for both the customer and the carrier. So it allows us to give real-time, accurate pricing to customers and carriers. We're also using AI for customer integrations, and so something that we've got a good runway left to go there.
Drew, when it comes to lots of talk about AI disrupting jobs here, the impact that's going to have on workers. In just the last week, we heard from IBM, from PayPal, that AI will replace their need for some workers. Is that the case with RXO?
It's not really how we look at the business. So what we see is that we're able to have our employees be able to do more per day. So what we measure is the loads per day. And so technology and AI allows them to do more per day versus elimination of the jobs.
When it comes to the workers, finding the workers that you need, obviously labor shortage has been a huge challenge specifically for your industry. What are you seeing?
Yeah, so we're still seeing a lot of talent come to us, specifically on our folks that are dealing with the carriers and the customers on a daily basis. And they tell us that they want to come to us because they want to come to a winning team that's disrupting an industry and this outperforming the overall industry. So talent has not been an issue for us on the carrier and the customer side. Technology talent is always a difficult, but we've been able to pull some of the best and the brightest minds across the biggest technology companies to help us create a winning platform in RXO Connect.
Has that been holding back your business at all? The fact that finding the workers with the right skill set in the technology area, that has been a little bit tougher?
No, it has not held us back. And you can see that because we're not only growing volume by 6% on a year-over-year basis, we've got the best margins out there within the industry. And so it has not held us back.
Your number one challenge right now for the remainder of the year, what would you say that is?
Yeah, so obviously overall watching the macro and the uncertainty that is still there. While there are reasons for optimism in the back half of the year, the macro environment's still an uncertain one, and being able to react and be able to continue to go out and outperform the industry and take market share.
Drew Wilkerson, always great to have you here, Yahoo Finance, CEO of RXO. Thanks so much for joining us.
Thank you for having me.
Julie?
Shauna, thanks so much. Really appreciate it. And Shauna's going to have much more coverage coming up for us from that Goldman Sachs Industrials and Materials Conference. In our 11 a.m. hour, she's speaking with Dave Regnery. He's Trane Technologies CEO. You don't want to miss that. But coming up for us, Warren Buffett says he doesn't want to compete with Elon Musk, but there are a bunch of EV makers that do. Rivian, for example, says it's on track with production targets. How much upside is there in the stock? We will have more next. Get to some movers here. Rivian reporting a narrower than expected loss in the first quarter. The company reiterating it is still on track to meet its production target for 2023 of 50,000 vehicles. Let's bring in Pras Subramanian with the latest. Pras, it's been an interesting EV season so far for earnings. What do we hear from Rivian?
Yeah, hey, Julie. So, yeah, we saw actually good news for the EV beat, right? So they had a revenue beat here, a slight revenue beat of $661 million, but it was a big jump from a year ago. Also a narrower EPS loss versus what Wall Street expected. So that's good for them. But more importantly, you mentioned they reiterated that 50,000 annual production guidance, which would be a double of the amount that they made in the prior year. So that's good for them. Their outlook, they see a $4.3 billion adjusted EBITDA loss for the year, which is $900 million less than a year ago. So that's good. They have about $11 billion in cash on hand. So that should fund them through at least the next year. And they also have expect to achieve a gross profit by 2024. So that's something that they're sort of looking ahead to. Investors are sort of hoping that happens because, as you know, the story with Rivian is that the products are great, but the question is, can they survive? Do they have enough run rate to survive through the kind of evolution of the EV landscape?
And so, Pras, while we have you, let's also talk a little bit about Fisker and Lucid here, too.
Yeah, so Brad, Lucid, on the other hand, we had two reports. Like Lucid, first off, earnings miss as well as revenue sales miss there. They said they'll produce 10,000 cars this year, which is the bottom end of their original forecast of $10,000 to $14,000. And a lot is counting on here, Brad, on their new Gravity SUV, the SUV that they're hoping will be their big seller. That won't launch till next year. So the issue is that they have enough money to kind of go through Q2 of 2024. So you'll have this car come out, but then you also have a potential cash crunch. And the question is, will they need more capital then? Will the Lucid Air, their current sedan, sell enough and be profitable to kind of boost their sort of fortunes before that car comes out? So a lot of question marks there for Lucid. Fisker as well, just real quick. They had to cut their production forecast slightly from 36 to 32,000. Some issues there. They began deliveries, but there's some potential issues there with software that Bloomberg reported on. And apparently some cars are actually not going, they can't go that fast. They have to operate at a slow speed. Fisker is vehemently denying that, and they say that other issues will be affected by a OTA update. So a lot going on in space, some good, but some bad.
Yeah, I mean, it's interesting to sort of like now get that overall view, right, of the EV landscape following the earnings season. You got Tesla up here, and then you have the others kind of arrayed here. How should investors sort of be thinking about them, particularly the newer entrants to the market, kind of like where they stack up, if you will?
Yeah, you have Tesla over here doing its own thing profitably, making pure play EV cars. And then you have Lucid, Rivian, and Fisker on kind of shaky ground trying to get to the point where Tesla is right now. And I think Wall Street is sort of appreciating the old legacy automakers like Ford and GM, who can actually make a lot of money with their traditional gas-powered ICE business, use that to fund their EV endeavors. But at the same time, let's say in the future, if Americans aren't transitioning to EVs fast enough, Ford and GM can shift back to ICE, or they can go to hybrid, which the other guys can't do. So I think there's more of an appreciation there for these traditional automakers who can sort of play both ends, because right now, starting a car company and making it profitable is a long journey, and Tesla proved they can do it, but there's a lot of other companies that have not been able to do that over the last 100 years of the automotive industry. Yeah,
and even with Tesla, there were a lot of questions along the way over whether it was going to be able to do it after all. Pras, thank you so much. Really helpful look at the landscape there. And we're just coming up on the opening bell on Wall Street as investors continue to digest those CPI numbers that we got there earlier. And it looks like on balance, they have been judging those numbers to be relatively positive, or at least not worse than feared, as we were talking about with Matt Miskin earlier here. Let's do a quick check of the market, sponsored by Flex Shares in the wake of all of that. And again, we are seeing this positive reaction here. So that number, which as we pointed out earlier, on a year-over-year basis, rising 4.9%, headline consumer price index, which is the first time we've seen the number below 5% in a couple of years. The core number is still above where the Fed wants to see it, but it does feel like that there is progress being made, and that is reflected in stocks this morning. The Nasdaq leading the advance. It's up 0.9% right now, followed by the S&P up 0.2%, and the Dow up about 0.5% as we get underway here on this Wednesday morning. So that, Brad, really the pivotal data of the week that people have been watching for, bracing for, perhaps.
Yeah.
and it wasn't as bad as it could have been.
Yeah, it seems relief is in the pudding this morning, indeed. Taking a look at the Dow Jones Industrial Average over the course of the past 3 days and coming into this activity, net past 3 days still holding on to gains of about 0.2%. But here out of the gate this morning, you're seeing gains of about 0.5% right there. Nasdaq Composite, you're seeing that higher by about 0.9% past 3 days, still net positive, and the S&P 500 as well, now net positive with today's move. And so that is the importance of continuing to track this CPI data and any of the economic data reads to see how the market is digesting that, because without this morning's moves over the past 3 days, we would not be in positive territory for the S&P 500 or for the Nasdaq, and definitely not for the Dow as well. So ultimately, we'll keep a close eye on that. Let's also take a look at the 11 S&P 500 sectors here as we pull it up on our handy dandy heat map. Taking a look at them right now, we're in positive territory across the board. Take a look at consumer discretionary and technology. Consumer discretionary right now up by about 1.2%. Technology also higher by about 1.1%. Speaking of technology, let's go to the tech-heavy Nasdaq. Take a look at some of those mega-cap tech stocks out the gate this morning. Apple, Microsoft, Google, all those up roughly 1%, a little bit more than that for Alphabet, Google, whatever. Amazon, they're up by about 2.2%. And NVIDIA, the chip company, that's higher by about 1.5% this morning. We'll keep all these movers close in eye. But Airbnb, as we were mentioning earlier on, just to get a quick check of them at the market open, they are down by about 11.7%. That coming after their earnings report and the conference call. And of course, we'll be speaking with Brian a little bit later on this morning.
Yes, we will. And you were just looking at the big cap tech there. NVIDIA is the only one that hasn't reported yet. That is due on May 24th after the close of trading. So we'll be looking ahead to that. But let's turn our attention now to the gaming space. Two companies going now in the same direction. They had been trading in opposite directions in the video gaming space. Roblox shares are rising right now, but the company did see losses accelerate in the latest quarter. The company citing that they will slow down their increase in headcount, so slow hiring, while Electronic Arts shares getting a boost after the company beat estimates on the top and bottom line and said its latest FIFA game has outperformed since its release. So let's just take these quickly one by one here. If you look at those Roblox numbers, it looks like users did improve here. First quarter daily active users, 66.1 million. Yeah. That is ahead of estimates here. And that was even though the company had said earlier in the year that users fell in March from February. But if you look at the first quarter overall, you saw some improvement there. EBITDA down 22%. That came in below estimates. So initially, again, we did see a decline there, but now the shares have turned around.
Yeah, I'm going to paint a broad stroke with this one here as we kind of think about all of the companies that have reported, at least in the gaming sector, their earnings, whether that's Roblox, whether that's Electronic Arts, EA Sports, it's in the game, or at least here today in the game for the time being. We'll see if they hold on to these slim gains. Activision Blizzard, who had already reported as well. One thing that kind of stuck out to me was the commentary from EA Sports CEO Andrew Wilson saying that interactive entertainment right now is at an inflection point here. And you think about a couple of the themes that we've heard about over the course of the past year that are certainly changing the course for these companies at large. And you can even weave, of course, Take-Two Interactive into this conversation, but things like the metaverse and where immersive technology are going to change the gaming structure, where cloud has already really disrupted where the access to that game takes place. And that even changes the type of device or console that you're using. And the console was the last thing that I had written down as well within this. And so with the disruption, with the inflection, that inflection point that the industry is at as a whole, there's going to be so much more focus on not just how quickly a lot of these companies can create titles and perhaps where they can leverage artificial intelligence to write more quickly some of that code for the experience, but also where that experience takes place and how much each of these companies have to buy into developing specifically for where gamers are most apt to have that console experience or cloud-based experience based on the device that they want to use as well.
Right, and then, I mean, obviously the blockbuster games helped as well. That's what helped EA during the quarter. Yeah, the FIFA release was a big one for them. So that, you know, content is king, I guess, still. And then also, as you're talking about distribution, is Prince maybe? I don't know.
Yeah.
We're using that analogy.
It's in the castle.
Yeah.
For sure. Also, let's talk about Duolingo here this morning. Duolingo shares, they are seeing a pop this morning after the company beat revenue estimates in the latest quarter. The CEO touting strong user growth in the first half of the year. The company also talked about the excitement over the new AI product, Duolingo Max here. Shares are up by about 2.7%. I'm glad that they talked about this new AI product, because if there's one thing that has been a constant thread about where AI could immediately have success, it's in language translation, and how much more easy it would be for people to engage with a language translation artificial intelligence application or tool rather than learning an entirely new language, perhaps, which is what Duolingo had really based so much of their business on leading up to the time that they went public, and really a lot of the fanfare, people who wanted to take on a second or third or fourth language. And so how Duolingo gets this AI component right could actually set the tone for retaining that base of customers that they've relied on to this point.
I mean, at the same time, we heard the likes of Chegg saying earlier this year that they weren't going to be affected by, by generative AI, and then it seems they were. So is this just a delayed effect? Is it something that's going to hit Duolingo later? Yeah. I don't know. I mean, I would make a couple of points about Duolingo. First of all, this is one of the rare class of 2021 that is above its IPO price. Came public in July 2021 at $102 a share, and as you can see, it's trading at around $138. So it has seen some momentum as people have come into this. On the other hand, as we talk about sort of Google Translate or whatever it may be versus actually learning a language. I mean, people are always going to want to learn languages. Yeah. I think, I hope, I don't know. On the flip side, Google Translate is not, it's fine as it stands. Maybe something like generative AI will make it better. It doesn't get idioms. It doesn't, like, if you put in, as someone who used it recently on vacation quite a bit, if you put in a longer sentence, it is not something that translates well. If you put in words, if you put in short phrases, it can handle it. When it comes to really having a full communication with someone who does not speak the same language, it is much more challenging.
Can I put on my futurist hat for a second here? Because I think, say you and I speak a different language.
Yes.
And we both have AirPods. Yeah. And we both have the same type of device experience. Say that we both just have to put our AirPods in, and our device is doing the artificial intelligence or the kind of necessary work to run that translation in real time to the best ability possible, and perhaps based on some of that artificial intelligence component is course correcting where there may not have been an apples to apples type of conversion in the actual word or the phrase. And I think that's the future that can be a reality should the technology companies get this right, and that's where it could impact Duolingo.
I mean, was it Hitchhiker's Guide to the Galaxy where they put a creature in your ear and then you can understand?
Yeah, the creatures are AirPods.
Yes, maybe so. And then I think of Star Trek where they actually had this little thing in the communicator or whatever it was, the translator. Yeah. A lot of potentials from science fiction to take our cues from. I do not want a creature in my ear, though.
No. Oh my gosh, no. Oh gosh. Okay. Guys, we're also watching some more earnings movers this morning. Let's talk a little Wendy's as shivers are going up my spine about creatures in the ears. Dutch Bros and Occidental Petroleum, they're all on the move today. After posting results, we're going to break down those results throughout the show today. We'll be right back. Let's get to the food space on this busy earnings day. Wendy's reporting a beat on the top and bottom line this morning, but the real news there might be the company adding AI technology to drive-through windows. Yahoo Finance's Brooke De Palma is all over this one. She joins us on set. Brooke, all right, so artificial intelligence in the drive-thru, that's what's happening now.
Artificial intelligence in the drive-thru, the company weighing in on that, saying that Google Cloud is a great partner for them and they're looking to increase speed and throughput. They said that's the opportunity there. Their slowest part in the drive-thru is that order station. And ultimately the company, beating earnings when it comes to adjusted earnings per share, but on revenue, a miss there, coming in at $427.40 million. In addition to that, taking a closer look at same-store sales, similar to what we're seeing across the board for these food chain companies, beating in same-store sales. We saw global same-store sales up 8%, here in the U.S. up 7.2%, and international same-store sales up 13.9%. Now, the company did say that total pricing for the year, as far as menu price increases, about 7%. They did run a little bit higher last quarter. They had said it was 6% in the previous quarter, but I like this phrase. They said that the proof is in the pudding. They're not seeing much resistance there in terms of customers pushing back to that pricing. They said that under 75,000 and over 75,000, they're maintaining share in both income cohorts, but they are seeing traffic growth in over 75K. We're seeing a lot of consumers trade down into fast food during this earnings season. And in addition to that, I love when sort of my worlds come together. They did mention the impact of grocery CPI coming down. They said that perhaps this will leave customers with more disposable income as those grocery prices come down. And so hoping to get a bit of a boost in foot traffic there.
I keep thinking about the AI discussion. Like, they're going to need to upgrade the speakers.
Yeah.
If they're going to upgrade, like, the...
But this will be entirely sort of a AI component interacting. They said it's going to be a female voice that's going to be at this pilot phase. And so also they're looking to see if it boosts sales there, because this AI technology can say, hey, you want a larger size, or do you want to add a Frosty, or hey, we have these daily specials. And so Wendy's really banking on the potential opportunity to increase sales with this AI technology.
Why would they ask? Of course I want the Frosty.
I know,
What
but
do you
maybe
think I
not
came to
everyone
Wendy's
does.
for?
And Wendy's certainly wants you to get that Frosty.
Yeah,
so.
most definitely. Let's talk about Dutch Bros as well, because that's another food company out with numbers this morning. It's taking a hit, down 10%. Revenue came in well below estimates, despite its 30% jump in revenue year over year. It also missed on same-store sales. What's going on at Dutch Bros, right? It had been on kind of a tear.
Yeah, well, certainly the Wall Street responding, I guess, poorly today, down 10%, as you just noted. Also seeing some downgrades across the board from Wall Street as well. But results narrowly missing here on adjusted earnings per share, down, or narrowly beating rather, down 1 cent compared to Wall Street estimates of down 3 cents, and also a miss on revenue, but revenue did jump 30% year over year. And so the company really emphasizing that to investors this morning. In addition to that, we also saw same-store sales down 2% across the board, with company-owned stores down 3.5%. And that's with an 8% pricing, more offset by an 8% drop in traffic. But the company continuing to persist, continuing to develop, hopefully one day soon, making their way to the East Coast here. Of course, they did start on the West Coast in Oregon, and they did open up 45 new shops this past quarter, 42 of which were company operated across 9 states. And they said that all of these new shops continue to be led by existing or newly prompted regional operators. But one thing there that they did note on their earnings call is that they're looking to get more people, more perhaps brand awareness in these new stores, looking to increase volume there, and that may take some time. And so while we know about Dutch Bros, perhaps these new places that they're operating may not have full brand awareness.
And we're going to speak with the CEO of Dutch Bros coming up in the next hour. Yahoo Finance's own Brooke De Palma helping us break down all things earnings in the yummy landscape, the food.
Absolutely.
Coming up, everyone, kicking the can down the road. The debt ceiling talks resume on Friday with President Biden and House Speaker Kevin McCarthy looking for some kind of agreement. Is invoking a 14th Amendment clause really an option here? We're going to discuss that next.
for sure you would see interest rates going up on mortgages, on auto loans, on credit cards, a whole bunch of things that are indirectly tied to the rates on treasuries. I think you would have a lot of chaos, to say nothing of the fact that we got to pay the people in the armed forces, we got to pay Social Security. How is it going to work if we can't do that? I think this makes no sense. They have to figure it out.
That was Chicago Fed President Austin Goolsbee in an exclusive interview with Yahoo Finance earlier in the week, warning of the risks if Congress can't lift the debt ceiling. And they haven't done it yet. President Biden and House Speaker Kevin McCarthy failing to reach an agreement yesterday as the impending June deadline creeps ever closer. Joining us now is Jeanette Lowe, Director of Policy Research at Strategas Securities. Jeanette, thank you for being here. I guess, first of all, I want to talk about the potential repercussions, but to sort of set the stage here, you being somebody who's close to the Beltway, seeing what's going on there in Washington, I guess nobody knows what's in the hearts and minds of the players, but from what we can tell, do you think that they will come to an agreement before the deadline?
Well, first of all, thanks for having me. Second, so we didn't really expect much to come out of the meeting yesterday. This was kind of the first meeting after the House passed a bill. That was important because that was round one of these negotiations. So now the principals have sat down and they just kind of reinforced what they were each thinking, what their sides are. But at the same time, it's important because what we saw was two important things come out of that meeting. Number one, they instructed staff to start working today on some negotiations. And two, they set up a future meeting on Friday for the principals to meet again. So to us, even though it doesn't seem like we made much progress yesterday, we think that we are still on a trajectory to actually get this done. Doesn't mean that there isn't some risk, doesn't mean that there couldn't still be a policy mistake, but our view has always been that this is probably going to go down to the wire. That is generally what happens in Washington. So this could be something that doesn't get resolved until the 2 weeks before June 1st or just the week before June 1st. And of course, there is a risk that we could go over the X date, but we would just caution that that's not really a default because the Treasury would likely have some cushion and the Treasury would prioritize Treasury payments, so we would not actually be in a real default.
How much cushion would we have? If we did go over the X date, June 1st, when would kind of a hard deadline then become after that?
So we think the Treasury probably has a few days. Treasury Secretary Yellen is not going to give an exact estimate of what her cushion will be. It could be 25 billion, it could be 100 billion, but she's probably going to give herself a little bit of a cushion so that if potentially we went over the X date, there would be some time to kind of get something still resolved, because that pressure of having gone over the X date would then make policymakers move. And then second, it would give her some cushion so that she wouldn't have to worry about actually starting to prioritize government spending payments at that time.
So tell us sort of in concrete terms, if indeed we pass the deadline, where there could be temporary cutbacks, and for sort of break it down for normal Americans and investors, what would be the most direct and immediate effects?
So what would happen is that the Treasury has said in the past that they would prioritize payments on interest and principal for maturing securities. What would happen is that they would likely prioritize payments for Social Security, for Medicare, for defense, likely for veterans care, but then they would have to make a decision about paying other bills. So that could be whether or not they pay other government contractors, whether they pay education, things like that. But I would caution that this is a very small probability. More likely is that we think that there will be a deal. They just sides have to save face in some way. So Biden obviously has been calling for a clean debt ceiling increase. Speaker McCarthy has been adamant that we need spending cuts. They're trying to probably figure out a way where maybe we do two separate votes. Maybe we have a two-step process where we set up a framework for spending cuts and with the debt ceiling now. And that gives us a couple of months to then fill in the details. And then the debt ceiling would automatically be triggered to raise again for another period of time once we actually get those details filled in. So I would say, although, there's not concern about default if we cross over the X date, That is the lowest probability, and there is still a much higher probability that we actually do get something done. I think yesterday you did see, although there was still some tensions within that meeting, there was also some constructive statements about the fact that we would not default.
Is it clear what both sides of the aisle are asking for as they're looking to get this debt ceiling raised, or just getting the overall approval to move this forward?
Right. So Speaker McCarthy has probably three main asks. He wants to put a cap on discretionary spending going forward. He wants to pull back COVID money that has not yet been spent, and he wants to do energy permitting reform. The Biden administration is going to put forward its priorities on energy permitting reform today. So that shows some overlap there. Obviously, the president, although he's been calling for a clean debt ceiling increase, has also intimated that he is open to budget discussions. He just wants them separate. So I think that there's still some understanding that there will have to be some austerity measures coming into play. One of the things that's important is that we had the April budget data come out on Monday, and it showed that the U.S. fiscal situation is rapidly deteriorating. And one of the things that we watch in particular is what is happening with net interest costs as a percentage of tax revenue. So this is because interest rates have been going up, then it costs more for the U.S. to service its debt. Those costs are now 12.7% of tax revenues. We have found in the past that once they hit 14%, the financial markets tend to impose austerity on policymakers. And so something does have to happen on the budget. Biden will also probably push for some tax increases. So Biden had put a number of tax increases in the budget that he put out in March. We don't think large things like an increase in the corporate tax rate or an increase in individual tax rates would be on the table, but maybe something smaller, maybe something like an increase in the buyback tax rate. That could be something that could be on the table. But there are areas where they could find an agreement. They just also need to figure out how to structure it, so probably both sides can save some face in this.
We'll see what that ends up looking like, and hopefully it will happen. Jeanette Lowe, Director of Policy Research at Strategic Securities, thank you so much. Appreciate it.
Thank you so much.
Coming up, results season, inflation data, and an unclear picture on Fed policy, giving investors lots to think about this morning. We'll do a broad sweep of the market action next. Let's take another look at what is trending and what's going on in these markets, because we've seen the Dow now turn negative, and we've got the S&P that is coming off of its highs as well. The Nasdaq still holding up pretty well. I was looking for some of the culprits here, and it looks like oil might be part of the picture. Oil prices have turned back lower. You see WTI off by 1.75% here, still above $72 a barrel. But if you look at the sector action here, what we've got is energy is bringing up the caboose, as Brad says, or bringing up the rear, and definitely providing a drag on the Dow. In particular, utilities and consumer discretionary are in the driver's seat here. But if you look at energy stocks individually, you definitely see a lot of red on your screen. Exxon down more than 1%, along with Chevron and ConocoPhillips as well. Flipping back on over to the trending tickers proper here, and to see what is going on in that department. We have a lot of the earnings-related movers that have been on the trending list today. Roblox up about 5%. Upstart, which we're going to talk more about in a few moments, up 34%. Airbnb down about 12%. And Twilio, the software company, disappointing with its numbers, down by 13%, Brad. So people still watching those earnings very closely.
Yeah, watching them fervently here this morning, and we've got a lot of them in that trending tickers category.
Yeah.
Continue. One of them is Celsius as well. We'll perhaps get into that a little bit later on in the show, but that also on the move this morning, up some like 20% right now. Also, everyone, on the other side of this short break coming up, inflation is slowing for the 10th straight month, but is it still too high? We're going to speak with a panel of experts next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. Let's take a quick look at stocks here. Earlier, we had seen all three major averages higher. Oh, now they're higher again. What is going on today? There's a lot of bouncing around. It's a fairly narrow range, but I just checked, 3 minutes ago, and the Dow was lower, and now it is up about 0.2%, not a huge gain. but just sort of, I guess, gets at the crux of the difficulty right now in figuring out how to play these markets amidst the economic signals and the earnings signals that we're getting, Brad.
Yeah, technical term here for the folks at home, a little bit of a waffle Wednesday, if you will. So we'll continue to watch that. We're also keeping close tabs on inflation. Inflation slowed for the 10th straight month in April, climbing 4.9% year over year, but still held firmly above the Fed's 2% annual target. Joining us now, we've got Lakshman Achuthan, who is the Economic Cycle Research Institute co-founder, and Paul Grunwald, who is the S&P Global Economist. Great to have you both here with us today. You see a print like this morning come out. You're the Fed. You're digesting this data. What does the signal for even the course of conversation at the next meeting where you need to make a decision?
Yeah, well, the numbers were a little bit better, right? So the Fed's focusing more on core than the headline, but the core is still 5.5. And then late last week, we got the PCE core, which they also follow, which is about 4.5. So I guess directionally, we're going the correct way, which is lower, but we're still well above target. And we know the labor market's still very hot, right? Unemployment dipped down to 3.4 last week. So the pause is kind of conditional or data dependent, if you will, on how things are going to play out. But, we're kind of winning little battles, but we haven't won the war yet on inflation. I think we got to wait to see if we can get down to 2.
Yeah, it feels like we're in the percolation period, right? Where the Fed's raise, and now we kind of wait for it to make its way through a little bit more, right?
Sure, it's like, you're a kid in the car and you're like, are we there yet?
Yes.
And it doesn't happen that fast. Yes, we're in a cyclical downturn in inflation. That's the good news in a sense. But it's a little sticky on the way down. It's not a straight line down. And the core services, the wage inflation, these are real concerns for the Fed. So as you were saying, with unemployment at 3.4%, that's like a 54-something year record low. That's not giving them a break. That's
Right.
not giving the Fed a green light to pause or cut. And so here, I don't think it really gives them any quarter to ease. And there's also a separate, I just want to clarify something. There's the pace of inflation, right? And then there's the level of prices. And so Wall Street, we're all into the pace of inflation. Hey, we can see it's decelerating. Okay. Main Street, people out there are all looking at the level of inflation.
That's a good point.
And if you think about something like a car, used car prices, they're about 50% higher than pre-COVID. That's a big step up. And people feel that.
And our wages are not 50% higher?
Not quite. They're higher.
We got some real wage negative numbers this morning as well, which is also part of the calculus, right? Because inflation is high, and this kind of disproportionately hits the more vulnerable parts of the population, which is why we need to get inflation down. And there's still a way to go. But totally agree on the point. The level of prices, the rate of change of the prices may be slowing, but the level's still quite high, and this is taking away purchasing power.
And depending upon income level within the population, you could already be experiencing perhaps, and by the time we get to a real recession as defined, you could already have been in a recession for quite some time. So what does that do on a much kind of longer term outlook for an economic recovery across income levels as well?
Yeah, well, fuddy-duddies like me think that inflation needs to get back down to 2, because I agree with the point that it's probably easier to let inflation go to 3-ish and then settle there, but that's not really a dynamically consistent story, because the next time we get a bout of inflation, you might say, well, maybe 4 is good enough, and then you go down this slippery slope. And if we think that high inflation and prices hurt the most vulnerable, which I think is empirically true, then we want to kind of, tough it out and get back down to 2. But, we're laying the foundation to get the economy on a more sustainable path. And, that's a path where, unemployment's kind of low to mid 4s, inflation's 2 is kind of our golden path. But we ain't there yet. We're trying to land softly to that path.
Well, yeah, and I totally agree with you, and it's totally disconnected from what the market wants, right? So the market is looking for a pause or a cut, and that is just not in the cards. If you're going towards 2%, right, which is linked to the Fed's credibility, then in cyclical terms, if you look at cycles in growth and cycles in inflation, you have to acknowledge that these low points in inflation, when it cycles down, only occur after the recession is over. And we're talking about, did it start yet?
Right.
Okay, so just to give you again this idea of time, and are we there yet? It's going to take a little while. We're not there yet.
Yeah, Julie, that's your percolation challenge, right? When we were behind the curve, it was easy to raise rates aggressively, but now we're at the point where, we're probably close to where we want to be in terms of the peak of the cycle. We know that monetary policy works with a lag, and we know things are going to be slowing down. Then it gets a little bit trickier, right? Because you're trying to be, a little bit tough on rates to make sure financial conditions are appropriate to get your inflation down to 2. But because of these lags, we're going to see the progress after the slowdown, and that's where the communication gets really tricky for central banks. Fed, ECB, a lot of central banks are in that bucket right now.
Yeah. So are we? So what you guys are saying, it sort of leaves the door open that are we actually? Is the Fed actually done? And I mean, in other words, yes, we'll give some time to see how these changes work their way through the economy. There's a lot of folks who are sort of waving their hands in the air and saying things are terrible right now, and that things are dire, and that the Fed needs to cut already, and that.
These are both true. But they're both. It's both true, right? Which things, there are things that are terrible. Real retail sales are down 5 months in a row. You don't see that outside of a recession. There's other things that
housing market. Some are saying is in a recession.
Starting to peak out. There's credit problems where you're starting to see that contraction. We're seeing all of these things that are totally consistent with a harder rather than softer landing. So. Yes, that's true. And the Fed, having missed the boat earlier, in order to maintain its credibility, has to get this inflation under control and really going down. And there's always something there that they say, but I think he said last time he was talking, Powell was talking, I need to see a couple of months of these numbers really in a more comfortable place. And today's not that day.
Right. Yeah, I was going to say I agree with that. The market pricing is still, when I checked yesterday, we had a couple of cuts priced in by the end of this year. The market wants to go there, but the Fed's watching inflation. And again, because they and other central banks missed the boat, a lot of us economists missed the boat last year, they still have a 2% target, and they don't want to miss it on the high side and have to start hiking aggressively again. So I think they're going both ways. I'm not sure today's data point really tips it either way, so we'll have to see how it plays out next couple of months. I think that's right.
We had got some data from the New York Fed as well, saying that inflation expectations, they're falling at short-term horizon, but rising slightly at longer horizons as well. What does that signal for how the Fed might still have some hiking to do later on should inflation rear its head again?
Well, it definitely supports a higher for longer, right? What you're really concerned about, if from a central banker point of view, is longer term inflation expectations inching up a bit. So if you look at the 70s, and we were all very young then, if you were even alive, right? You have these, if you were even alive, right? So you have these cycles in inflation. And what's interesting is when they're tightening and inflation's coming down, tons of pressure, political pressure, all this stuff to stop tightening. And the bottoms in the inflation cycle get higher and higher. And that's what they don't want to repeat.
Right, and to that point, if your medium-term inflation expectations are well anchored at your target, which is 2, which means the market and the population thinks you're going to deliver on your mandate, that actually makes your work a bit easier, right? They got partially de-anchored last year, which means, as we like to say, everything else constant, the Fed and other central banks are going to have to do a little bit more in order to bring inflation down and re-anchor those.
The market, though, doesn't believe it. Right? I mean, I don't know. It keeps changing, right? I'm looking at December probability right now from the Fed Watch, the CME Fed Watch, and 4.25 to 4.5 is where most of the bets are clustered right now. That implies a cut. 46.3% probability right now. Now, this keeps changing, to be fair, but is it just wishful thinking on the part of the market that the Fed's going to cut before year end?
I'll go quickly because I want to let you speak. This particular cycle, if you kind of track that since when did the Fed lift off? March of 2022. The market has been underestimating the Fed every move this cycle. So they've got this psyche, it used to be called the Greenspan put or the Fed put or the whatever put. They think that the Fed's fill in the blank put, that the Fed is gonna sort of cave and cut rates when things get a bit dicey. They raised in March in the middle of the Silicon Valley Bank sort of turbulence, and they raised again this past week. So maybe again we're gonna see that the market's underestimating the fortitude of the Fed this cycle.
Or, I mean, I'll take the other side, because I agree with what you're saying. So it was a long time ago we said, look, the Fed's going to keep doing this until either they're getting hit in the face with a recession or something breaks. The market may be betting in a weird way, something's going to break. Because when you take all of the business models that are out there that are predicated on really low interest rates and rapidly change that cost of capital, stuff starts to falter.
Although to Paul's point, something did break.
Well,
and the Fed still kept going.
Let's wait.
Okay, so something terrible is going to happen. Is what the market's banking on.
The other way to put that in is if you're telling me the Fed's going to be cutting 3 times by the end of the year and sitting at 4 1/4, 4.5. I'm asking what your macro forecast is. You don't have the unemployment rate at 3.4, and you don't have all this inflation pressure. So they've got a recession in there.
Things are going to get bad. Hopefully not. All right, guys, thanks so much. We got to leave it there. Really great discussion. Lakshman Achuthan, Economic Cycle Research Institute co-founder, and Paul Grunwald, S&P Global Economist. Thanks to you both. Really appreciate it. Fun stuff. Let's take a look at, as fun as an economic discussion about recession can be, let's take a look at one trending ticker that we're watching now. Shares of Upstart are surging this morning after the company forecast revenue well above expectations for the current quarter after seeing a vast decline from last year in their latest report. Upstart CEO said despite headwinds, they had secured multiple long-term funding agreements. Coming up, affirmation, hard to find for one buy now, pay later group, although one analyst has had affirmation in their title of their report on the company. The perfect storm of bank turmoil, rate risk, and recession fears weighing on the sector still. We're going to speak with the CEO of Affirm next. Let's do a quick check of the markets, now sponsored by Flex Shares. At the highs of the session, at least for the Nasdaq, it's up better than 1% here. We have seen this rally in large cap tech today in particular that has been an interesting one. The S&P 500 up about 0.5%, but the Dow is bringing up the rear here. It is little changed. We've got energy stocks that are sort of dragging on the Dow. That is part of the issue there. We also are seeing a pullback in bond yields in the wake of this morning's inflation data. The 10-year yield right now down 6 basis points to 3.46%, call it. So that might be something that's giving some relief to those large cap tech stocks.
Well, shares of Affirm initially reacted negatively following the company's fiscal third quarter earnings report, but are now in positive territory, up 1% as trade has commenced. And on a conference call to discuss the financial performance, the leadership offered detail on momentum areas such as its direct-to-consumer business and Debit Plus Max, while also acknowledging the anticipation of continued capital market volatility in the current quarter. Affirm founder and CEO Max Levchin joins us now. Max, great to have you here. Great to grab some of your time off of the back of this earnings report. When you think about your business and pertaining to your business, you talked about capital market volatility in the quarter and on the call. Where would that show up in the performance and in the financial metrics for the business?
Thank you for having me. And capital markets is the lifeblood of our business. Our capital team is the bringer of what we lend out, the money that we offer our consumers at the point of sale. Obviously, as the Fed figures out how to combat inflation, it changes our cost of capital. That puts pressure or relieves it on our ultimate bottom line, revenue less transaction cost. And as the Fed changed rates quite dramatically, had a real impact on our LTC. That said, the quarter we just printed, we've always said that we intend to drive our LTC number between 3 and 4%. We're just a smidgen below 3 last quarter. We printed an exceptional quarter. It was 3.6 this last one. We still affirm our plans to be between 3 and 4. Just shows that the business ultimately is really resilient. We have a tremendous amount of consumer and merchant demand. There will be short-term disruptions from capital, from other places, but ultimately this is a great business. Seems to be performing really well, and I think majority of it is thanks to the team's excellent execution.
Max, it doesn't sound like you're convinced that the Fed has figured out how to fight inflation. You know, even as we're kind of parsing through some of the figures from this morning's inflation report and CPI report.
I certainly think it's too early to tell. I'm not making any bets about the forward curve that's not reflected in the forward curve, but I do think that their work is starting to bear fruit. I think the CPI came in below expectations for a good reason. That's generally good news for us at Affirm in the long term, sense that the cost of capital will ultimately come down as the spreads come in and narrow down a little bit. Again, I'm primarily focused less on the Fed, much more on my ultimate customer, which is the consumer and the merchant. We saw great growth in activity. We're very focused on being there where our consumers need us. So frequency of usage is a really important metric. All those things we beat across the board. Business is just humming on all cylinders. Team is executing really well. The Fed will do what the Fed will do, and we'll roll with it, and just like we always do.
Give me a little more detail, Max, if you would, on how you guys are compensating for it, right? Because you talked about that a little bit in the statement and on the call, doing some, seeing that that rates are going to continue perhaps to move higher. You guys talked about some pricing initiatives and levers that you all can pull if that macro environment continues. Give us a little more granularity, if you could, on those levers.
Sure. And actually, I should step back and sort of explain probably the single most important thing that we had not mentioned, perhaps because we've done also so well in that one. So quality of credit, maintaining good yield for our capital partners is job number one. So we printed another great quarter with delinquencies coming down. If you look across the industry from every bank, every lender out there, you see delinquencies on average going up. Ours went down. We managed our credit outcomes very, very carefully. One of the things we can do to improve profit margin is to just be extra careful with our approvals. We underwrite every transaction. We have a lot of control over what we will and will not lend to. So that's the lever we control the most, the lever we care about the most, is just maintaining exceptional quality of credit. And that's what we certainly did last quarter. We have all the intention of doing it. The other obvious thing we can do is we can pass some of the increased cost of capital on to consumers or merchants. We have two major constituents. We have reported that we expanded our APR ranges that our consumers pay by 600 basis points to about half of our merchant base. That's an ongoing project. We'll continue doing that, and we'll just have wider APRs available to our loans and therefore be able to approve more people. That's the other one. And then over time, as we get to scale, and most importantly, as we prove that we really are in control of the credit outcomes, we get better and better deals with our capital markets partners as they recognize that we're able to deliver them yield without creating too much volatility. That allows us to tap into deeper pools of capital, folks that don't need crazy high risk, high reward returns, but much rather have really steady, well-managed yields. And that's certainly where we are spending a lot of our time now.
So if I understand you, Max, it sounds like, maybe I'm reading between the lines too much. You tell me. In this environment, when we are going to see a tightening of credit, there are going to be people who cannot borrow from traditional banks because of this environment. Maybe they're going to come to you. And it sounds like you are broadening things out a little bit, if I'm understanding you correctly. How do you balance that with the sort of a firm push for conservatism, right, in this kind of environment?
So I'm not sure we really compete with banks. We lend money at the point of sale, and the primary alternative to a firm, or we are the primary alternative, given that this is very much a David and Goliath fight, are credit cards. We compete with credit cards. And when consumer says, you know what, I'm already overextended, I'm revolving, I have no idea what I'm paying in interest, Affirm is a great alternative. All of our interest is capped. It's always simple. There are no late fees. It's a much, much, much healthier financial product. And so we are maintaining credit by way of literally telling folks, hey, you are overextending yourself. You shouldn't borrow money. We don't benefit if you're late because we don't charge late fees. That's the way we regulate credit, basically over borrowing. And so in that sense, we're quite conservative, always have been. We're always making sure that our consumers are not overextending themselves. If we're able to pass the cost of increased funds cost onto the consumer by offering them a slightly higher APR rate, or onto merchants who pay us for every transaction that happens according to whatever contract we have with them. In those cases, we can approve a little bit wider because that allows us to compensate for the extra risk we take. But generally speaking, our posture towards the consumer credit and overall economic outlook is still quite conservative. I'm not yet celebrating the end of inflation or the impending lowering of rates or anything of the sort.
Max, does anything you're seeing in Affirm's data about the way that consumers are looking to finance purchases at the point of sale right now signal to you that they are bracing for a severe recession?
No. In fact, I can tell you that consumers are still very excited about travel. Travel and ticketing is one of the strongest categories we saw the last couple of quarters. People are sick and tired of being at home. They want to get out of town. They are traveling. They're staying in hotels. They are renting cars. They're going on cruises. All of those areas are areas of meaningful growth. Travel ticketing last quarter grew 60+% for us, which is quite a lot. The other side, the darker side of the considered purchase economy, if you will, are things that you bought during the lockdowns. So if you're buying an exercise machine for your home or you're buying fancy kitchen equipment, that's probably getting postponed as you're figuring out how to deal with inflation. And there's real pressure on folks because of rising prices, in particular rent prices. So consumer is still fully employed. They're doing fine. They're paying their bills. They're still shopping, but they are figuring out whether the dollar goes to point A or point B. And generally speaking, if you wanted to sort of make a blanket statement, point A, where the dollars go, is events and experiences, and far less so goods that will fit into your kitchen or your spare bedroom.
Max, it's great to catch up with you. I wish we had more time, but we got to go. Max Levchin, Affirm CEO, thank you so much. Appreciate it.
Thanks for having me.
We got to go because we got to get to another conversation. Shares of Luminar Technologies right now are down 3.6% after that company reported first quarter numbers. The auto tech company reporting a wider than expected loss per share of 24 cents. Analysts have been looking for a 21-cent loss. Revenue did beat estimates and backed full year revenue growth of at least a doubling. Luminar providing updates on business plans for the year, including a new factory in Mexico and expansion of its technical talent team and partnerships with automakers Mercedes-Benz and Polestar. Joining us now, Luminar CEO Austin Russell. Austin, it's good to see you. So we saw those that earnings per share or loss per share, I should say, missed in the quarter. I believe that had to do with some of the costs from the Mexico plant, which I mentioned. Is that going to be sort of the bulk of that happening in this past quarter? How's that going to look for the remainder of the year?
Yeah, so I think when it comes down to it, just to be clear, that that loss was actually totally within our guidance range for what we gave. So maybe we also need to figure out how to better ensure that aligns with what we have. But it's all completely consistent with what we have for the year. We've been meeting every business milestone that we had along the way. And actually, our growth has been significantly better than expected, when it comes to our business, our revenue, our order book, our products, all of basically everything along the way. So I think it's fair to say, though, that, there's obviously a lot that we have to be able to execute along the year. But we've been effectively meeting or beating every milestone so far from, not just the past year, but even so far this quarter.
Do you see any expense expansion necessary to kind of meet the demand within that order book that you have right now?
No, actually, quite the opposite, when it comes down to it. So I think as we continue to, accelerate on the business and we get the benefits of the economies of scale. And what that means is that the actual cost structure significantly reduces along the way. From a profitability standpoint, we actually have some pretty clear outline goals from a product profitability from a gross margin perspective this year. We core business overall profitability next year, and then everything all in for the entire company and all the future bets that we're making for the following year after that. So that's all been accelerated. We're actually on track to be able to meet all of that, and even by the end of the year, just as a reference point, we'd expect our costs to be our recurring costs to be roughly half at a run rate of where we are today. So that's like I said, we should hopefully we can make it to be like I said, not just the company that has the most or more value or contracts than everyone else combined for LiDAR, AV of the public codes, but also certainly the first profitable one too.
Let's talk about, we were just showing a full screen that talked about expanding your technical team. And I know you guys just hired some folks from Argo AI, which is a one-time competitor that then ended up closing. What do those folks bring to your team? What do you expect sort of the next phase of the technology or the next phase for Luminar to be on that front?
Yeah. So we're definitely continuing to ramp on all fronts there too to make that successful, and that's just accelerating the technology roadmap that we've had and product roadmap and capabilities. So everything's in a great place there. We're supporting a lot of additional business. So even just for example this past quarter alone, Mercedes had announced that Luminar is now being put across not just one vehicle model but across the lineup there too. Same with Polestar. They've announced that we're being put across the lineup. And for the first time, you actually see these multi-billion-dollar, contract value that has the opportunity to be realized over the coming years here as well. And this is just, again, continuing to drive growth, but we're leveraging the same core product and capabilities that we've had, for improving safety and enabling autonomous capabilities. So that's the beautiful part of the economies of scale as we continue to be able to ramp up with that. And that's also the reason why when you see from as those billions of dollars in contracts materialize into revenue, that's why we see this crazy growth of over 100% year over year for what we just reported for this quarter, and overall for the year we said at least 100% growth on revenue for the foreseeable future annually.
That's big. Austin, this might be a little bit out of left field, but you guys are very auto focused. Are there other applications for LiDAR in other kinds of businesses that you guys are also exploring, or are you just laser focused, forgive the pun, on autos, and that's where the business is going to be?
Yeah, so when it comes down to it, there definitely are other adjacent market applications, things that can utilize LiDAR for this. And, we work with some of those types of companies. We generally focus on the big ones. For example, like Airbus, is working with us to be able to start to equip this for, their up next division on helicopters and whatnot, for where you can improve safety on all kinds of, vehicles, not just on the ground, but in the air and other things. But I would say that the way that you become a $1 trillion company at the end of the day is by heavily leveraging and capitalizing on the existing automotive market and industry, and that's what we've been able to do very successfully. So we're working with the majority of the top 10 automakers, so we're going to continue to do that. And when it comes down to it, I think one thing to look out for that maybe is a flag, if you see anything or any types of companies that are pivoting purely into that, it's not clear how you could be able to build a successful or profitable operation when it comes down to it from that alone. So we're excited to be able to continue to leverage the sheer scale of automotive, and like I said, very high barrier to entry, but also very high barrier to exit as you're designed in. And we're proud to be very uniquely selected and positioned to be able to do exactly that for so many major automakers.
Austin, are full self-driving claims in market right now as cracked up or as clear or transparent as they need to be, or is the real thing still waiting to come?
Yeah, no, so I've been long been probably the industry's biggest skeptic around full self-driving capabilities and technology. Has been, you've been saying the same thing since 2016 when it comes to that there too, that there was a lot of things that people were over-promising and we're going to be under-delivering on when it comes to overall autonomous capabilities for full self-driving stuff when you take out the driver. And that's why, like I said, our business plan along the way in everything that we built the technology around is not around replacing the driver. It's about enhancing the driver. It's about making cars safer. It's about enabling autonomous capabilities on highways. It's about being able to get onto existing production vehicles not making a driverless robotaxi. Now that said, that the technology is directly applicable to that as well, and we do work with many of those companies that can do that. But that's a very, very challenging problem. Of course, the LiDAR makes it actually solvable and, orders of magnitude better performance and accuracy, et cetera. But nevertheless, that's still on a long time horizon. The thing that is happening today and what's accelerating, I think, even beyond people's wildest dreams and expectations, is that we're able to get designed onto millions of production vehicles there too that are actually out on the road that you can actually buy. And that's where you start seeing that ramp up on a global scale with us like crazy, starting with the Volvo EX90, and then throughout all of next year, that's where the crazy ramp continues to happen.
Austin, we know you got a busy schedule today. We appreciate you taking some of the time here to discuss the earnings with us and the forecast and the guidance here for Luminar. Luminar CEO Austin Russell, thanks so much for the time.
Thank you.
Absolutely. Guys, coming up, Occidental Petroleum took a hit this quarter as oil demand declined. So what's next for the oil giant? Inez Ferre has the details coming up. Shares of Occidental Petroleum, they are trading lower by about 4% after its Q1's earnings report. Q1 earnings reports show a pullback in prices for the energy giant, and their earnings coming in under the street's estimates as a global energy price, they're riding a roller coaster triggered by Russia's invasion of Ukraine last year. Yahoo Finance's own Inez Ferre, you saw her right there. She has more on this. Inez.
Yeah, Brad, and let's pull up the results for you so you can see adjusted earnings per share coming in at $1.09. That was a miss, down 48% year over year. Revenue for the quarter at $7.23 billion, and that was $7.23. That was also a miss, and that was down 11% year over year. So it's no surprise really that the price of oil has impacted results. The business in terms of profit is mostly focused on upstream. That would be exploration and drilling. And we have seen the price of oil coming down significantly from last year. And just to give you an idea, in the first quarter of this year, oil sold for about $74.22. So the company was able to sell at that price per barrel. Look, Last year, it was significantly higher, 19% higher. So that's a 19% drawdown in that price of oil. Now, the miss is overshadowing the production growth because production grew 13.7% year over year. And Cowen analyst noting this with Cowen analyst David Deckelbaum, he has an outperform rating on the stock, $70 price target on the stock, and he highlighted the production beat and also noted that despite the miss, capital expenditure was well managed, coming in about 1% lower than consensus. This company has been focusing on buying back shares, doling out its dividend. IXIC repurchased $752 million of common stock. That's about 25% of its $3 billion annual repurchase program, guys.
And as obviously Occidental has been in focus, not just for its actual business, but because Warren Buffett and his investment in the company's got just under a 24% stake in IXIC. And he talked about his investment at the Berkshire Hathaway shareholders meeting on Saturday. That ended up sending the stock a little bit lower here. But how should we be thinking about that Buffett investment?
Yeah, look, he likes this company, and he said so. I mean, he spoke quite a bit about Occidental Petroleum. He likes the company. He really likes and respects the leadership. Vicki Hollub is the CEO of Occidental Petroleum. He's talked about her before and her leadership. And about that original investment that was made in Occidental Petroleum back in 2019, he said that when the pandemic hit it and you saw oil prices going negative, it seemed like it had been a terrible idea to invest in this company. But then it turned around and it ended up being a great investment. But as far as taking control of the company, he said that they have no plans to take control of the company. And he said, quote, "We're not going to buy control. We've got the right management running it. We wouldn't know what to do with it." He said, but they do love the shares and they may or may not buy more shares. And Berkshire does have a regulatory authority to a regulatory approval to buy up to 50% of common stock of Occidental Petroleum. So they certainly could buy up more shares if they wanted to. They really like the company, but they're not looking at owning it full right or taking full control of it.
Right, at least not right now. Inez, thank you so much. Our own Inez Ferre there. Coming up, what's moving markets? We've got some trending tickers on the other side of the break. Shares of First Citizens Bank shares are on the rise today. If you recall, this is the company that bought Silicon Valley Bank in late March at a deep discount. Remember, buying $72 billion of the bank's assets at a discount of $16.5 billion. It got $56 billion worth of deposits at that point. So we're getting some more details today on what that did for First Citizens. Deposits in the first quarter, $140 billion ahead of estimates there. And also, we already saw Silicon Valley adding to the company's bottom line.
Yeah, 30x the increase in profits that they saw for the first 3 months during that first quarter of 2023, and that coming after the purchase, as you mentioned. Some of the additional details: net income that came in at about $9.5 billion, or $653.64 a share. That is up from $16.70 a share same period last year. And so this, of course, still, as we are continuing to watch some of the regional bank turmoil that continues to ensue right now.
Yeah, and this made First Citizens one of the top 15 banks in the nation as a result of this deal. The company says deposits are still going to drop a little bit by year end for the full year, $132 to $137 billion. Will be the total, but that's still above what analysts had been estimating. And the company, as you might expect, increased its provisions for credit losses because of its acquisition of SVB.
Yeah, that one of the provisions that we've seen across banks broadly over the course of the earnings season. Everyone, coming up, having a bank you don't like is similar to that buddy from high school that always wants to hang out. He's annoying, but dropping them is too much effort. Boy, do I know it. We discuss where you could be looking to put your money next. Not with that friend. The recent banking crisis is leaving customers and small business owners wondering, where's a good place to park some cash? So how should you choose a bank, and how do you know that it's the safe decision? Here to help us answer these questions, we've got Andre Jean-Pierre, who is the founder and managing director of ACES Advisors, as part of our financial advising segment, brought to you by Flex Shares here. And as we are continuing to really parse through the broader banking, we do have him. Okay. Andre, just want to bring you into the discussion here. How does somebody go about selecting the right bank, especially amidst all of the kind of banking turmoil that we have seen ensue?
Hi.
Hey there.
How are you?
Good, good. Hey, just want to resend the question to you, Andre. How does somebody go about selecting the right bank, especially as they've heard a lot about the banking turmoil and the banking crisis that has ensued that might have them wondering where the right place to park cash is?
Well, it's important for an individual to understand how SIPC insurance and FDIC insurance operates. So it's important to understand that $250,000 is the level of FDIC insurance. So if you are having a proper allocation, anyone under a $10 million allocation or asset level will probably not have $250,000 in cash. So for the average individual that is not looking to have over a 5% level of cash in a portfolio, we're going to be looking at somewhere around 2 or 3 different banks that they can use to maximize the FDIC insurance. So to use one bank might not be the proper way to do it anymore if you have over $250,000 in cash. But for the average individual who has under $5 million in assets, it's probably best suitable for them to maximize the FDIC insurance.
And Andre, I would imagine for those folks who do have those large cash positions, that maybe they want to be earning money on that cash, so they don't have it parked in the bank, but they have it in other assets. But even when they are trying to figure out not just to where to put their savings, right, but who to bank with, whether they're talking about a mortgage or they're working through you to figure out who's going to manage the assets, right, as a part of your financial advising. What are some of the criteria that you talk to people about, especially now after all that has happened?
I think it's more important than ever to do your homework and your research in regards to where you park your money, right? The days of being able to go to any bank and thinking that they have the same amount of security, those days are over. So to do your homework about the balance sheet and understand the risks that each bank is exposed to is very, very important for the everyday individual to do. I do believe that it may be out of the scope of many people's ability to understand. So I think that is important to work with a professional that has a specialty in finances and banking to help you make that decision if you can't make it on your own, because at the end of the day, it is your own money, and it's important that you protect it for yourself and your family.
Why continue to park kind of large sums of capital in the bank versus putting some of that capital to work? And how do you go about, in that case, if you do choose to go the bank route, making sure that you're selecting the right account for that capital to grow interest?
Well, I want to make it clear that I don't think it's prudent for the everyday individual to keep over $250,000 in cash in a bank. If they are saving for retirement or for the long term, it's probably better to diversify your assets and own some investments, to own some bonds, to own stocks, equities, and so forth. I do believe that cash is an important part of anyone's long-term investment portfolio, and it allows you to move with and diversify and rebalance as you see fit. But to be honest with you, the everyday person, I don't believe $250,000 in cash makes sense for them. And I do believe that the reason why a lot of people are in cash is something that I like to call paralysis by analysis, that they're going through with the overload of information that they're going through on a day-to-day basis, trying to make decisions for themselves. So in today's day and age, we have more information flowing to us that influence our financial decisions every day. And back, let's say, even 15 years ago when I started, it might have been 10 sources of information that you were using. Nowadays, it's closer to 50, 60, 70 sources of information. And this can be confusing for the everyday person. which can either do one of two things. It can lead them to make more decisions than necessary and try to be overly tactical, making several moves a day, several moves a month that are not in their best interest. Or the opposite of that, which I'm seeing a lot, is paralysis by analysis, where they get so much information that they decide to do nothing and they decide to stand still. And as we know, with inflation moving the way it is, that's not the best decision for the everyday individual as well.
And Andre, just really quickly here, is that what you're hearing from your clients right now? Are they sort of freaked out by everything that's been happening this year?
Yes. I think we've been spoiled a lot over the past 12 years or so in regards to the stock market having a long bull run. A lot of people, especially during the pandemic, decided to grab their finances and decide to start investing on their own, doing research on their own. And I love the intensity and the thirst for knowledge. In 2020 was definitely an interesting time in the investment world. But the flip side of that, when we return to normal in regards to investing, has caused a lot of people to not understand what's going on and also have a total influx of diversified opinions and financial data that has made them pretty much stand still in the middle of the street like the deer in the headlights looked. And, with that much information coming in and not being able to process it and not having a team in place to understand these differing points of view, it's caused a lot of my clients at first to have a paralysis by analysis. But after you sit down and you have the conversation about what the data means and how it affects their long-term plan, they can come back to normal, come back to baseline, and start making decisions that influence their long-term life and their long-term financial plan. Again.
Deer in headlights, fainting goats, paralysis by analysis. I think we all have now the phrase to keep in mind and what not to do, but to hopefully take some action here and make the decision with the factors that can ultimately input that. Thanks so much, Andre Jean-Pierre, who is the founder and managing director of ACES Advisors. Let's do a quick check of the markets here, sponsored by Flex Shares as well. Taking a look at the major averages, the Dow, the S&P 500, and the Nasdaq. We've got them loaded up for you on your screen. We're seeing some mixed activity, though we've seen both sides of the tape here today. The Dow and the S&P 500 in negative territory, though, as it stands right now. The Nasdaq holding on to some fractional gains by about 0.3%. We'll continue to monitor this.
Yes, we will. And coming up, Rochelle Akufo has you for the next hour of trading, and she's going to be joined by Airbnb CEO Brian Chesky on the back of those results. This guy will be there too.
I will.
Yes, he will. All right, keep it right here on Yahoo Finance.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Still high, but slowing. A better than feared inflation report giving investors a tailwind on another busy day. April's consumer prices grew at 4.9% on the year, the first reading below 5% in 2 years. And battling those prices, consumers have been resilient when it comes to their favorite brands. Dutch Brothers benefiting, but shares slump as it misses sky-high revenue hopes and gets downgraded. Its CEO joins us this hour. And the formerly most watched anchor on cable news is taking his show to Twitter. Well, that's what he says. Elon Musk says they haven't signed a deal of any kind. We look at the impact on both brands if a deal does happen. But first, let's check in on the major indices on the heels of that CPI data. We're seeing a mixed picture here, though reaching for daylight just barely there. The Dow just slightly down about 1/3%, 112 points. We're seeing Visa weighing on the Dow at the moment. In terms of the S&P 500, up now just barely though, about 2 points there, at least being buoyed in terms of what we're seeing from energy and materials being the laggards there on the S&P. Taking a look at the Nasdaq, at least seeing some gains there, also up almost 0.5%. They're about 54 points, buoyed by the FANG stocks, except for Meta right now. Let's also check in on the Treasury market as they're hoping the Fed perhaps has a little less work to do going forward. We see the 5-year here down about 2.7% there in those short-term yields. The 10-year down almost 2% on the day, and the longer-term 30-year yield down 1%. Well, still high, but slowing. A better than feared inflation report boosting stocks today. April's headline figure grew at 4.9% on an annual basis. That's the smallest 12-month rise since April of 2021 and the first reading below 5% in 2 years. Now, the core number, however, is still holding tight at 5.5%, and that's the key for the Fed's policy. Yahoo Finance's Jennifer Schonberger is here with more. Hey, Jennifer.
Good morning, Rochelle. That's right. With the reading on that headline number dropping below that key level of 5%, that was encouraging, though the core level remaining sticky, though not getting worse. And for that reason, many on Wall Street think that this number alone may not nudge the Fed higher to raise rates higher. Take a look at the Fed funds futures this morning. They've been pretty volatile as of 10:50 a.m., pricing in about a 8.5% chance of a rate hike in June. It was as high as 13% earlier in the morning. More so, we're going to get another read on CPI and a PCE, the Fed's preferred read on inflation, before the Fed meets again in mid-June. So a lot more data to come. But this morning, bond portfolio manager from Wilmington Trust, Will Stith, telling me that the CPI number fosters more of a pause for the Fed, but not by much. Net, he says it paints a narrative that things are continuing to move at a slower pace gradually. Meanwhile, capital economics economist Andrew Hunter wrote in a research note, quote, "We don't think that this will persuade the Fed to hike again at the June FOMC meeting, but it does suggest a risk that rates will need to remain high for a little longer than we have assumed." Now, taking a dive into that number, while the headline figure continues to drop, the core rate has remained sticky this year, oscillating between 5.5% and 5.6% this year, down from about 5.7% at the end of last year. But Fed officials expect a slowdown in rents to come that will eventually show up in these calculations, causing core inflation to fall. And that's something that New York Fed President John Williams attested to in a speech on Tuesday, though he also said that so-called core services excluding housing shows inflation is still sticky, which we saw very much in this report. He says that's being driven by an imbalance in supply and demand. Now, juxtapose this with the fact that Fed officials are also looking closely at credit conditions, which have been tightening to see if that may offset pressure of inflation in this economy. We got evidence of further tightening in credit conditions in a survey on Sunday. And Chicago Fed President Austin Goolsbee told me in an interview on Monday that he thinks we're at the very beginning stages of a credit squeeze. Of course, the magnitude of that remains to be seen. Nevertheless, we're at a point right now, New York Fed President John Williams says that they're not giving explicit forward guidance on interest rates. However, taking this report in stride alone, it doesn't appear that it could nudge the Fed higher. Of course, again, Rochelle, a lot of data expected between now and the middle of June. Back to you.
So certainly explains why we've seen that sort of mixed picture that we're seeing in the market reaction. Yeah. Appreciate that update. Jennifer Schomburger there for us. So, inflation cooling on a headline level, if still elevated. The Shelter Index is the largest contributor to that number. Shelter rising 0.4% in April, and it's up a whopping 8.1% on an annual basis. For more on this, we turn to Brad Dillman, Cortland Chief Economist. Brad, thank you for joining me this morning. So, as we mentioned there, when we think of how much shelter, and especially rent, makes up in this CPI data, I mean, a slower increase than some were expecting, but how would you characterize where we are in terms of rent prices?
Well, I think it's certainly good to see it finally tick down a little bit. I mean, the number's still high. That shelter inflation print is the first time it's really gone down since it started to increase in early 2021. As for how I would characterize rents, look, annual rent growth has been slowing since the summer of last year. But of course, there's plenty we could say about where it may go in the future, too.
Indeed. And one thing that's interesting, because you talk about how you characterize the methodology of how these rent increases are calculated in the CPI data. And you say there's actually a better way to calculate it that would better reflect what's actually happening with some of these rent prices. Break that down for us.
Yeah. The Cleveland Fed put out a great paper where basically they replaced the rent component and the shelter component of inflation, and basically replace it with a new lease rent growth index. So it was not just renewal leases and new leases, it was only new leases. And what we can see is that in the rental market, this is where rents are set on the margin, right? New leases tend to flow to renewal leases. And basically, their study concluded that inflation would be a lot lower if one only looked at new lease rent growth, because that had been slowing for much of the second half of last year and even into the early part of this year. So by that measure, inflation's actually lower. On the flip side, if we were to look at our own data at Cortland, where we're seeing new lease rent growth, it looks like it could start to tick back up again.
So with that in mind then, looking at your calculations then, has the Fed over-tightened at this point then?
Well, so I think that's basically what the Cleveland Fed was suggesting, that maybe that was the case. At this point, no, it wouldn't look like that at face value. I mean, the CPI print is still coming in very strong. I think even if you do replace it with this new lease rent growth index, as the Cleveland Fed did, and you see new lease rent growth occurring as we have over the last several months, you see an indication that you may see a return of inflation, and therefore that makes the case for a higher for longer. Not necessarily a Fed funds rate at 5% in perpetuity, but not going back to zero either.
And for a lot of people out there wondering why their rent is still so high, I mean, there's a number of factors at play. You had excess housing starts when the pandemic first set in and people were sort of rushing, at least they thought, to build more houses. And then you have inflation, you have the cost of materials, cost of labor, and we'll get into labor in a second. But I mean, you also have existing homeowners that just aren't incentivized to sell if they're going to take on a higher mortgage rate. How much longer do you think we're going to continue to see rents so high and so sticky?
Well, given that it's been inflation and that we are seeing it in wage growth, now granted, wage growth hasn't really kept up with inflation, but there's certainly some wage growth out there, that we're not necessarily in for sort of an outright deflation in the rent level. If we look at how rents have moved around the country, say over the last 6 months, there's only really a handful of markets where the rent level itself is down, over the last 6 months. And in annual rent growth terms, there's even fewer where it's actually negative. So rents still look like they're going to be quite strong. When we look at why they got so strong in the first place, we really look at the eviction moratorium. It created an artificially tight occupancy rate, which translated to an artificially high rent growth rate. Now, there may have been perfectly justifiable reasons for that, but those do have a consequence in the overall market. In fact, we concluded that about 300,000 units nationally had been taken offline. That's the equivalent of the conventional multifamily stock of metropolitan San Diego. So it was a lot of supply basically held off market that caused rents to shoot up. We have seen supply start to come as a result of that, right? Particularly back when rates were lower and a lot of new development projects penciled really well.
And as we look at some of these areas where we're seeing on a monthly and an annual basis where the rents are still rising versus where they're going down, one interesting issue that you highlight is what's happening with the labor market, an expanded labor market with perhaps more immigration coming in, stronger employment outlooks. How does that factor into what we will see with rent prices?
Well, it's two-sided, right? So when we look at the scale of immigration as it's been over the last few years, that's going to be a lot of housing demand, right? Multifamily demand or even for purchase housing demand. On the flip side, it's going to expand the labor market too. That should be disinflationary on the wage growth side, as we've already seen, and that's economists speak for basically a slowing rate of increase. So on the one hand, you're getting a lot more demand, and then on the other hand, you're getting some pressure on the labor market that may also mitigate the strength that we have seen in the labor market already. It allows for more jobs, but it may not necessarily translate to incremental wage increases and really define the picture coming out of the pandemic initially.
We'll certainly continue to keep a look at that. A big thank you to Brad Dillman there for joining us on Yahoo Finance this morning. Thanks so much. Well, shares of drive-through chain Dutch Bros slumping today as rocketing revenue missed very high expectations in the first quarter. Investors have set a high bar for the coffee company, surging Q1 sales and reaffirmed guidance, still not enough to boost sentiment, it seems. An analyst from Stifel attributing some of the disappointment to adverse weather events in California, saying 18 to 19% of the coffee chain's locations are in California, and a majority were impacted by weather in the first quarter. Dutch Bros also tanking today on a big downgrade from JP Morgan, the bank bringing the coffee chain down to neutral from overweight and dropping its price target to $32 a share from $38. All right, coming up, the formerly most watched anchor on cable news is taking his show to Twitter. Well, that's what he says. Elon Musk says they haven't signed a deal of any kind. We look at the impact on both brands if a deal does happen. Let's do a quick check of the markets sponsored by Flex Shares. Still a mixed picture at the beginning of this hour here. We see the Dow here just slightly in negative territory, although we are seeing that selling action slowing down about 1/3%. S&P 500 seeing gains there just slightly up about 5 points. And the tech-heavy Nasdaq also up about 0.5%, as we're sort of taking a look at what happened with that core CPI data, rising but at least slower. And that's a key measure for the Fed, but a sign it could be higher for longer. Hence that mixed picture we're seeing. All right, former Fox News star host Tucker Carlson says he's taking his show to Twitter, but Elon Musk says not so fast. The most watched anchor on cable news was taken off air last month. It was in the aftermath of Fox Corp's $787.5 million defamation settlement with Dominion Voting Systems. But in a video posted on Twitter yesterday, Carlson denounced the wider media environment and announced his imminent comeback on the social networking site, Twitter, of course. But Elon Musk didn't seem to know much about it. In a tweet, he said, quote, "I want to be clear that we have not signed a deal of any kind whatsoever. Tucker is subject to the same rules and rewards of all content creators." So, is he joining? And if he does, what kind of a boost will that give to both brands? Joining us to discuss is Richard Lawler, The Verge senior news editor. Richard, good to have you on here. A lot of people were wondering when they first saw this announcement from Tucker Carlson, was Elon Musk in on it? Elon Musk is like, look, he's just another content creator. But what does this move actually do for both Twitter and for Carlson?
Well, it does a lot of things for both parties, and thank you so much for having me. I think for Carlson, it gives a lot of freedom. There are some questions as to what options he actually does have after leaving cable news and having essentially been fired by every major cable news network. Where can he go now that gives him that same kind of platform? And one option is Twitter, because they have the kind of revenue sharing, they have the ideas of subscriptions. These are things that Elon Musk has said for months that he would like to do with Twitter. And obviously, he does not mind Tucker Carlson's political perspectives. And if they truly don't have any kind of agreement, then that would give him some freedom in the stories and the angles and the ways that he pursues them. So that may be something that Tucker Carlson would find very appealing. I don't know if he'll find the same monetary benefit that he was experiencing at Fox News, but that is something that both Elon and Tucker would like to promote. And for Elon, that could be something that would attract more people to use Twitter as a distribution platform for video.
It's true, and we know that, Musk was supposed to be this X-everything platform, to have transactions on there as well. But I doesn't really frame this move as, this is the move to free speech. He said, world out there where you can't have a lot of free speech on a lot of platforms. He said, quote, the last one is Twitter. The only one is Twitter. But to leave it there for a second. We'll be right back. Stay with us.
A firm is bouncing back from losses despite the buy now, pay later firms seeing their losses triple in the quarter from a year ago. The company was once pandemic darling, but now has fewer bulls. 17% of analysts, their rating shares a sell. We had the chance to speak to a firm CEO, Max Levchin. Take a listen to what he had to say about the buy now, pay later space.
Capital markets is the lifeblood of our business. Our capital team is the the bringer of what we lend out, the money that we offer our consumers at the point of sale. Obviously, as the Fed figures out how to combat inflation, it changes our cost of capital. That puts pressure or relieves it on our ultimate bottom line, revenue less transaction cost. And as the Fed changed rates quite dramatically, had a real impact on our LTC. That said, the quarter we just printed, we've always said that we intend to drive our LTC number between 3 and 4%. We're just a smidgen below 3 last quarter. We printed an exceptional quarter. It was 3.6 this last one. We still affirm our plans to be between 3 and 4. Just shows that the business ultimately is really resilient. We have a tremendous amount of consumer and merchant demand. There will be short-term disruptions from capital, from other places, but ultimately this is a great business. Seems to be performing really well, and I think majority of it is thanks to the team's excellent execution.
Max, it doesn't sound like you're convinced that the Fed has figured out how to fight inflation. Even as we're kind of parsing through some of the figures from this morning's inflation report and CPI report.
I certainly think it's too early to tell. I'm not making any bets about the forward curve that's not reflected in the forward curve, but I do think that their work is starting to bear fruit. I think the CPI came in below expectations for a good reason. That's generally good news for us at Affirm in the long term, sense that the cost of capital will ultimately come down as the spreads come in and narrow down a little bit. Again, I'm primarily focused less on the Fed, much more on my ultimate customer, which is the consumer and the merchant. We saw great growth in activity. We're very focused on being there where our consumers need us. So frequency of usage is a really important metric. All those things we beat across the board. Business is just humming on all cylinders. Team is executing really well. The Fed will do what the Fed will do, and we'll roll with it, and just like we always do.
Give me a little more detail, Max, if you would, on how you guys are compensating for it, right? Because you talked about that a little bit in the statement and on the call, doing some, seeing that that rates are going to continue perhaps to move higher. You guys talked about some pricing initiatives and levers that you all can pull if that macro environment continues. Give us a little more granularity, if you could, on those levers.
Sure. And actually, I should step back and sort of explain probably the single most important thing that we had not mentioned, perhaps because we've done also so well in that one. So quality of credit, maintaining good yield for our capital partners is job number one. So we printed another great quarter with delinquencies coming down. If you look across the industry, from every bank, every lender out there, you see delinquencies on average going up. Ours went down. We managed our credit outcomes very, very carefully. One of the things we can do to improve profit margin is to just be extra careful with our approvals. We underwrite every transaction. We have a lot of control over what we will and will not lend to. So that's the lever we control the most, the lever we care about the most, is just maintaining exceptional quality of credit. And that's what we certainly did last quarter. We have all the intention of doing it. The other obvious thing we can do is we can pass some of the increased cost of capital on to consumers or merchants. We have two major constituents. We have reported that we expanded our APR ranges that our consumers pay by 600 basis points to about half of our merchant base. That's an ongoing project. We'll continue doing that, and we'll just have wider APRs available to our loans and therefore be able to approve more people. That's the other one. And then over time, as we get to scale, and most importantly, as we prove that we really are in control of the credit outcomes, we get better and better deals with our capital markets partners as they recognize that we're able to deliver them yield without creating too much volatility. That allows us to tap into deeper pools of capital, folks that don't need crazy high risk, high reward returns, but much rather have really steady, well-managed yields. And that's certainly where we are spending a lot of our time now.
So if I understand you, Max, it sounds like, maybe I'm reading between the lines too much. You tell me. In this environment, when we are going to see a tightening of credit, there are going to be people who cannot borrow from traditional banks because of this environment. Maybe they're going to come to you. And it sounds like you are broadening things out a little bit, if I'm understanding you correctly. How do you balance that with the sort of a firm push for conservatism, right, in this kind of environment?
So I'm not sure we really compete with banks. We lend money at the point of sale, and the primary alternative to Affirm, or we are the primary alternative, given that this is very much a David and Goliath fight, are credit cards. We compete with credit cards. And when consumer says, you know what, I'm already overextended, I'm revolving, I have no idea what I'm paying in interest, Affirm is a great alternative. All of our interest is capped. It's always simple. There are no late fees. It's a much, much, much healthier financial product. And so we are maintaining credit by way of literally telling folks, hey, you are overextending yourself. You shouldn't borrow money. We don't benefit if you're late because we don't charge late fees. That's the way we regulate credit, basically over borrowing. And so in that sense, we're quite conservative, always have been. We're always making sure that our consumers are not overextending themselves. If we're able to pass the cost of increased funds cost onto the consumer by offering them a slightly higher APR rate, or onto merchants who pay us for every transaction that happens according to whatever contract we have with them, in those cases, we can approve a little bit wider because that allows us to compensate for the extra risk we take. But generally speaking, our posture towards the consumer credit and overall economic outlook is still quite conservative. I'm not yet celebrating the end of inflation or the impending lowering of rates or anything of the sort.
And that was our conversation with Affirm CEO Max Levchin. We'll be right back with much more on the other side of this short break. Shares of Dutch Bros taking a hit this morning after revenue came in well below estimates despite a 30% jump in revenue year over year. The fast-growing coffee chain also missed on same-store sales estimates, but did open a record 45 new stores. Joth Ritchie, who is the Dutch Bros CEO and president, joins us now alongside Yahoo Finance's own Brooke De Palma. Great to have you here with us this morning. Take us into some of the numbers. I mean, you still have a very aggressive growth plan here. And Wall Street reacting, sending the shares lower here. What do you think that Wall Street might be missing about that growth plan, and what needs to be reiterated about that pathway?
Well, I think, first of all, thank you for having Dutch Bros. And, I think we're in the early innings of a long-term plan. And so, our path to 4,000 stores is going to have some highs. It's going to have some challenges, and we're working through those, quarter after quarter. So, I think that the opening 45 shops in the first quarter, we were lapping a difficult lap from first quarter of 22, of which our sales were up because we were still kind of coming out of Omicron and had been the benefit of being open 100% of the time, and we knew the first quarter of this year was going to be a challenging lap as we kind of looked at the year. But long term, 45 shops. We'll open 150 locations this year. We opened 150 last year. So, if you take last year and this year, that's 280 locations on a 700 plus shop base, and we feel really good still about the long-term prospects.
And also, too, you've been aggressively growing in Texas in particular. And I think on the earnings call yesterday afternoon, some analysts were questioning how exactly you're increasing brand awareness and bringing in volume. So can you add some sort of color to that about how you open up these new stores and drive customers into them? And if you're seeing perhaps a misalignment there?
No, actually, we're very pleased with the response in Texas, from El Paso to Houston to Dallas and really everywhere in between. We've taken a very aggressive approach there. We decided to go in and kind of execute this fortressing strategy that we have and go in and do urban, suburban development, and introduce the brand. We know that building this brand is it's a long-term play. Our shops don't open to maximum potential right away, and we've seen that happen in Las Vegas in the past. We've seen it happen in Denver in the past. We've seen it happen in Tucson in the past, for example. And we just see, a more aggressive approach to Texas is really playing out the way many other markets have in the development of this brand over the last 30 years. So, we're very pleased with Texas. We're very pleased with the response we've had. We're pleased with the word of mouth and the growth and the service and the staffing that we have in that market, and really excited about, what that gives us for the future. So, super excited about Texas, and we've been opportunistic on some real estate there and decided to take a fast approach, and we'll continue down that path.
And you did see one of your largest sales in company's record history with a promotion that you guys did. I believe it was 4 medium drink promotion back in March. How does Dutch Bros view promotions as a key, perhaps essential part of this growth plan, and ultimately use it to drive sales?
Well, when promotions are important, and it's important to do it the right way. I think in many cases, we're still introducing the brand and the several categories that we serve, to many new customers around the country. And so we've got to find trial driving promotions to get people into shops, buy those extra drinks and showcase some of the things that maybe you didn't know you could have in a day. And beverage is also it's a daily habit, it's a daily pattern, and so we have to go in and introduce the brand. We've got to introduce why our products are better, and why the service and the great part of your day when you come to Dutch. Our people are serving you with a smile. They're taking care of you and giving you a service that maybe you can't get anywhere else. So, but that combination of service and a great drink, we're trying to introduce to everybody along the way, and it's a curated process. So promotions are driving in a way to introduce you to things where you can experience more of the Dutch Bros menu.
Smiles as a service. That's a different kind of SaaS, Josh, that I hadn't heard before. So I like that. As we're thinking about the little luxuries that habitual daily purchase is, though, have you seen any pushback on price from consumers right now? And I'm thinking about that in the context of even today's CPI report that we were looking through, trying to get a sense of where consumers are seeing prices abate a little bit, or where they're pushing back and companies are being cognizant about how that relationship still needs to further.
I think that's spot on. I think that the price environment that we've been through in the last year or so, with the elevated price increases and the things that happened in 2022, I think everybody's watching consumer response. I think the general feeling last year is that those price increases were accepted, and we saw cost of goods inflation at record levels. This year you're starting to see COGS level off, and I think that everyone is evaluating their pricing strategies and even maybe reinvesting. I think that we changed our Dutch Rewards program in late March, and basically why we did that is that we could reinvest into more promos and types of offerings for the customer to drive traffic and build that long-term acceptance of the brand. So I think everybody's looking at it. I think price, I think promotion, I think that depending on how the cost of goods market shakes out over the back half of the year, we'll just have to see how all those things go. But we haven't seen much pushback. In fact, our loyal customers at the top end of our traffic. They've stayed with us. Those numbers have really been pretty even across the board. If anything, we've seen some pullback in maybe some of the less frequent shopper as we've kind of evaluated what's happened so far in 23.
And Joth, you and I have discussed how drive-through remains a key part of the Dutch Bros model. And yesterday we heard from Wendy's that they teamed up with Google Cloud. They're introducing an AI for voice ordering at their drive-through. Would you consider AI as part of a future Dutch Bros perhaps model?
Well, I think AI is going to be part of our world in one way, shape, or form. I think that for us, it's the balance of how do we maintain that great experience with our people in a service-driven model, but how do we utilize AI and other technologies to enhance the consumer experience? And I think there's some great back-end solutions to AI and other technologies that can do that. It can speed our lines up. It can help us be more attentive to the service side, where maybe the AI modeling can help us with some other predictive behavior in how the consumer is going to buy or purchase patterns. So we'll see. I'm very excited about AI. I'm excited about the potential of it. But in the meantime, we're focused on building out the rewards app. We've got some payment processing systems that we're using to speed up, and we've got some other back-end technology that we're working on. And I think you have to be investing in tech and tech systems now in order to prepare yourself for what's coming.
Well, we know that one thing AI does not have, it does not have a heart like some of the founders and CEOs and executives like those that Dutch Bros do. We know that that shows up through events as well, like the Drink One for Dane event in memory of your co-founder as well. So wanted to give that a shout out, taking place on May 19th. Joth, thanks so much for taking the time here on the day. We appreciate it. Dutch Bros CEO and President Joth Ricci, alongside Yahoo Finance's Brooke DePalma. Appreciate it. And coming up, everyone, the former most watched anchor on cable news is taking his show to Twitter. Well, that's what he said. Elon Musk says they haven't signed a deal of any kind. We look at the impact on both brands if a deal does happen. It's next.
Former Fox News star and host Tucker Carlson says he's taking his talents to Twitter, but Elon Musk says not so fast. The most watched anchor on cable news was taken off air last month. It was in the aftermath of Fox Corp's $787.5 million defamation settlement with Dominion Voting Systems. Now, in a video posted on Twitter yesterday, Carlson denounced the wider media environment and announced his imminent comeback on the social networking site. But interestingly, Elon Musk didn't seem to know much about it. In a tweet, he said, quote, "I want to be clear that we have not signed a deal of any kind whatsoever. Tucker is subject to the same rules and rewards of all content creators." So is he joining? And if he does, what kind of a boost will it give to both brands? Joining us to discuss is Richard Lawler, The Verge senior news editor. Good to have you, Richard. So first one to break this down, as we mentioned, Elon Musk seemed a little bit caught off guard and really framing this as he's just another content creator. But what does this actually mean when it comes to both brands and as well the rules, perhaps, that Carlson will be subject to? Oh, you're on mute, Richard. Can you unmute? We can barely hear you there. Okay, we'll be right back. We're going to take a quick break and work on that. Stay with us. Welcome back. Let's head over to Yahoo Finance's Shauna Smith, who's at the Goldman Sachs Industrial and Materials Conference. So, Shauna, what are you seeing?
So, Rochelle, Yahoo Finance has exclusive access here to the Industrial and Materials Conference being put on by Goldman Sachs. We are hearing from the top names within those two sectors. One of the big themes that we are talking about is really just the landscape right now for the economy and what the second half of the year looks like. Last hour, we spoke to the CEO of RXO, the truck brokerage business, Drew Wilkerson, and he was telling us that, yes, the macro environment is very, quote, tough, but he's optimistic about the improvement that we could see in the second half of the year. When we get to a couple of other big themes, I was just listening in on a fireside chat with the CFO of Southwest, Tammy Romo, and she was saying that the company continues to see strong demand for travel. That leisure demand is really what has been driving the numbers here. She expects that to continue in the very important summer season. Another big theme is investment in technology, AI. We know that certainly has been the buzzword, Rochelle, over the last several months. Well, it's a buzzword right here at this conference today. RXO was saying that they had had actually been investing in AI for 10 years, but they plan to incorporate it more and more. Differing in terms of what we've heard from some of those tech giants, they don't necessarily see it replacing jobs, rather really helping productivity here with each of their employees. Southwest also has plans to continue to invest in technology. We know that their network has had some issues over the last several months, and Romo saying that she expects the network to be in a much better place towards the end of the year. Of course, there is some buzz around the debt ceiling, what exactly that will mean for these larger companies. Now, there is an optimistic tone in terms of the fact that people still think that lawmakers are going to get a deal done. But like Wilkerson told us, the CEO of RXO, that you need to be agile, you need to be flexible, and need to be ready to adapt to all different types of markets. That certainly has been the case over the last few years for these business leaders. Coming up later today, I will be speaking with Mike Battles. He's a co-CEO of Clean Harbors, really getting a sense of the waste and recycling business, where he is seeing demand there. Now, this company has certainly been an outperformer. Shares up 20% since the start of the year, nearly 40% over the past year. So we're going to talk about what is driving that business right now. Also talk about reshoring and regulation efforts and exactly how that plays in to Clean Harbors. So we've got all that for you coming up here on Yahoo Finance today, Rochelle.
Thank you. I know Shauna does have us covered there. Great stuff there from that Goldman Sachs event. Thanks so much, Shauna. All right, stay with us on Yahoo Finance. We'll be right back. Taking a look at shares of GoPro today after an earnings miss. Adjusted loss per share coming in at about 3 cents under estimates, and revenue declining by nearly 20% in the quarter. You see the stock there off about 8.7% there. The camera company announcing it's restoring its pre-pandemic pricing structure, knocking off $50 to $100 on many of its camera models. The company's founder and CEO, Nicholas Woodman, writing in a release, quote, "We're implementing an updated go-to-market strategy that restores our product pricing to to pre-pandemic levels, which we believe will accelerate growth in units, subscribers, revenue, and earnings. Morgan Stanley, though, cutting its price target for GoPro by 40 cents today on the news. Another cut at Wedbush from $8 to $6. Shares are down around 18% since the start of the year. So, Brad, this is an interesting one. Even with the sort of promotional pricing that they're putting in here, investors really not on board with what they're seeing with this story.
Yeah, I think it comes down to the average selling price. You got to convince somebody that they're going to buy a camera that they're going to strap on top of their helmet or perhaps on their chest or on their bike or whatever the extreme sport is. I mean, I've seen a lot of drummers just put it on as well. And regardless of where it's going, it's a matter of how much they're buying it for. Remember, GoPro for many years has had to come out with these different tiers of that core camera product so that they could still appease even the entry-level GoPro potential buyer out there. The Q1 2023 street average selling price, $378. That's a 9% decrease year over year, and $394 as estimated on a constant currency basis. That's down 5% year over year. So what's all of that to say? Yeah, consumers, they're going to be extremely discretionary about how much they're spending on a GoPro device, especially if you're looking across what other camera devices you have that you're typically carrying around on a day in, day out basis, either in the form of a phone or, if you want high quality, in a DSLR. GoPro is neither one of those. Sure, it's great for some of those active kind of hands-on activities, but at the end of the day, if you feel like you can get away with just walking around with your phone or walking around with perhaps another camera that you can change lenses in and out of, that's where it creates even more of an obstacle for GoPro. That had also been a company that had tried out drones for a long period of time. Now there are a lot of other drone camera companies that are out in the market as well here. And so all of that considered, I think for GoPro and what they've had to continue to prove to the street, and if we were taking a look at the long-term stock performance of this, they haven't proven that to the street to this point in time. And that's where much of the chagrin has come into play as you're taking a look at the past year. Even on top of the long-term declines that they had seen over the past year, still moving lower by about 38%, and in a time where consumer discretionary dollars, especially in electronics, are going to be harder to come by, Rochelle.
And you raise a good point. I mean, when they first came out, everyone was, very excited about GoPro. We've come a long way in terms of camera technology and even what people are using their cameras for. I mean, in the earnings call, they did talk about their subscriber growth on their retail channel. That they do have a lot of stickiness there. There are always going to be those loyal people who stick with it. Your average person, though, I mean, maybe apart from you, is not out there, drumming and surfing and doing all sorts. So I think they perhaps need to read the room a little bit and really evolve and think what comes next here.
I mean, I look at my GoPro right now. I own a GoPro. I bought a GoPro. I got it from Costco. Great price. And honestly, Rochelle, I wore it maybe once or twice. I went snowboarding one year and got the wind knocked out of me. I went off a jump that I had no business going on. And so now I look at the GoPro and it's just a source of remembrance of how hurt I was when I took that jump. I got it all on video. It was great. I could watch it back, play it in slow motion if I needed to, but I still haven't figured out too many other instances where I need to be able to fire it up and then take the little chip out, or even continue to kind of transfer it to the remote app on my phone. So yeah, I've not gotten the full use out of it that I anticipated when I made that few $100 purchase.
See, and we'd have used that as cover video if I'd known that we had that video available. Next time.
It is out there.
Glad all is well. Brad Smith there for us. Thanks so much. All right, stick with us. Coming up, no hospitality from investors for Airbnb shares this morning. The inflation picture dampening the outlook for the company despite first quarter numbers that beat Wall Street expectations. The CEO joins us next.
Shares of Airbnb are lower this morning on a muted outlook. You're taking a look at ABNB, ticker symbol there on the Yahoo Finance platform. The company anticipating a strong summer travel demand, tempering some expectations that demand will match that of the post-COVID boom in 2022. The projected slowdown in revenue growth falls below some analyst expectations out there. Speculation that booking growth would fall further behind spooking investors there. Despite the dreary outlook, though, Airbnb saw strong gains in revenue and bookings, making 2023 the company's first profitable first quarter. CEO Brian Chesky joins me now. Brian, thanks so much for taking some time.
Thank you for having me today.
Absolutely. Let's talk about what was said on the call as well here.
Yeah.
We're taking a look at shares. Of course, the stock is going to move in whichever direction it does on any given basis,
Right.
but particularly on the back of earnings and on the back of some of the commentary. And I believe you said that long-term growth is only as strong as supply here, pointing back to 2020, 2021, where demand grew faster than supply. So is it an expected byproduct that as more rooms come online, which is what you're looking to do through the winter release and now even the summer release as well, that the average daily rate will continue to moderate just a little bit lower?
Yeah, I mean, I think like one of the biggest marketplace of the internet is Amazon. And what Amazon has taught us is that widest selection of products at the lowest price brings the most amount of customers. The same is true of Airbnb. We had incredible demand in 2020, 2021, but a lot of new people didn't put their homes in Airbnb. They were a little apprehensive listing their homes and having strangers in their house during a pandemic. And so demand increased faster than supply. Obviously, prices went up. That actually was really good for the financial statement. But what we're really focused on now is making sure supply is growing. Supply is growing 18% year over year. We've had sequential accelerated growth in supply. And as we do that, prices will stay modulated. And what we've heard from hotels is that they're expecting prices to go up this summer. So if we can stay the most affordable option in travel, we'll continue to drive a lot of demand.
Yeah, certainly. And so when we think about some of the outsized factors that you and the management team that were steering the Airbnb performance during the quarter, what would you point to? Because, I mean, this was still the first profitable first quarter for the company.
Well, I mean, like revenue was up 20%. XFX, it was 24%.
Yeah.
We have now done, I mean, maybe the thing I'd really point to is free cash flow. We've now done $3.8 billion in free cash flow in the trailing 12 months. So when people say there's unicorns by market cap and revenue, then there's a unicorn by free cash flow. And that's what we are almost 4 times over. So I think the company's incredibly efficient, and we can use that cash to be able to be more aggressive in the coming years to look at things like international expansion, things like that. So we're feeling really, really strong.
Is the generation of that free cash flow sustainable from what you're seeing right now in the operations of the business?
Yeah, absolutely. We said, what we said in our outlook is even though there's going to be some changes in timing for Q2, mostly because of Omicron, we are still expecting the same guide for EBITDA for the year, and we're still feeling very strong.
Let's talk about the revenue guide as well. That was something that investors paid close attention to. They got some questions on the call as well. And $2.35 billion to $2.45 billion is what you're guiding for in the second quarter. You look out further than that this year. What are some of the dynamics at play that are really driving the revenue forecasts here?
I think affordability is probably the number one thing. I mean, like a year ago, if I came here, I would have told you number one thing is flexibility. People were now more flexible, they could travel anywhere, and that's why we launched Airbnb categories. Over the last year, with inflation, people have less money to spend on travel than they did a year ago. And now, rising fuel costs mean that it's even harder and more expensive to fly. And so we're seeing that people are much more price conscious. That is a big focus on us. And we have been seeing a little pressure in North America, especially. So really trying to make sure that average daily rates don't continue to go up, perhaps even go down, by making sure we have enough supply, we have enough discounting tools, we show upfront pricings, which steers people the best total value. These are like really important things.
What we've heard over the course of this earnings season too from CEOs and CFOs as well is how they're looking into their crystal ball, trying to forecast a recession, what that impact might look like on their business. From what we heard from some of the bank CEOs, it's Q3 2023 is what they're pointing towards here. For the services sector, it's been different, especially within travel, because there's been this counter-cyclical recovery. Does anything about the services spending in travel among the consumers signal to you Q3 recession?
I really cannot speculate on a recession. I can say for certain, though, that people are absolutely looking for more affordable options, and they still want to travel on Airbnb. So we're really focused on making sure we have the most affordable options, and if we do, I think we're going to continue to see a lot of growth.
Some of the Yahoo Finance viewer questions that we always receive, and one of them, real talk, from myself as well, there are certain places that I honestly just won't travel because it comes down to safety. What mechanisms have you been able to put in place to make sure that the platform, the experience for both the host and the people that are traveling there is more safe at the end of the day?
And say, what's part of safety in particular?
And safety in the stay, making sure that you're getting somewhere and it's what you expected out of the trip.
Yeah, I mean, I think like it's really, really important that we say that like we've been listening to guests. We've been listening to the feedback we've had. And over last year, we've made, over 100 upgrades. We made 53 upgrades last week. The whole thing works on a reputation system. We now have reservation screening for hosts. We have 24/7 customer support, and we now have 2-minute support that we talked about last week. So if you have an issue, you can call us. Our team is staffed to be able to help you in 2 minutes or less. And ultimately, I think people, when they use Airbnb for the first time, one of the things that surprises how well it works. 70% of people when they stay in Airbnb leave a review. The vast majority of them are 5 stars.
Wow. Wouldn't we think about, and when you mentioned what we discussed last week, what does success look like in terms of some of the key performance indicators that you would track on the back of the summer 2023 release as well?
I think that success is going to look like people feeling like Airbnb is a better value, and Airbnb's experience is more consistent, and people feel like we heard them, we listened, and the product is getting better and better. Ultimately, if you just step back, almost anyone who travels somewhere in the world and they need somewhere to sleep, I think they could consider staying in a home. I think our market could be significantly greater. The biggest strength of our Airbnb is we're one of a kind. Mm-hmm. The biggest risk of Airbnb is we're one of a kind, and sometimes we're not as consistent as a hotel. I think that if we can continue to remain the most affordable big company to offer travel, and we continue to make Airbnb more consistent, I think we're going to see a lot more growth later this year and next year.
For some of the viewers, for anybody who goes to the Yahoo Finance platform and types in the ticker symbol ABNB, they're going to be realizing as well that for all of the travel space, even though that there has been this counter-cyclical recovery, that there are going to be some pretty tough comps that get lapped on the back half of this year as well. How do you go about managing the investor expectation, communicating, and through that transparency to the street, exactly what you're seeing within the data at Airbnb?
Well, I think part of it is just being out there like I am today. Yeah. It doesn't matter whether stock goes up or it goes down. You got to be able to be open, transparent, walk people through what's happening. And I think what's happening is we are today double the size as we were before the pandemic. The rest of the travel industry is far behind as far as trailing, as far as a recovery standpoint. And so it's really just telling a story about what's happening. And what's happening is the fundamentals of this business have never been stronger. Supply is growing faster than ever, growing now 18%, accelerating. We are getting prices down in North America. I think that's going to stimulate a lot more demand. And the other thing I'd say is we have a lot of big new opportunities on the horizon. One of those is international expansion. Right. We're seeing a lot of growth in Germany and Brazil, where we've launched our international playbook. We're going to be expanding out to other geographies around the world. And then we have some pretty exciting new products and services that we're going to be launching next year and beyond.
Okay, 2 questions. One on that international expansion first. Relative to the existing either accommodations or hotel framework that many people had in some of those international entities, where are you seeing those travelers taking price on Airbnb as compared to some of those legacy companies in the accommodations landscape?
Yeah, so I think that we're seeing a number of changes happening in the economy right now within travel. I think that a lot of people are starting to travel more cross-border again. They're looking for more affordable options. You've noticed the last 3 years, there's not been a lot of cross-border travel. There hasn't been as much urban travel. City centers haven't been fully reopened. People haven't felt comfortable. This year, this summer, I think we're going to start to see people taking a lot more big trips, traveling internationally. And as they're traveling internationally, they're going to want to save money. And as you know, an international trip is more expensive because of the cost of an international flight. And so if you have a long international flight that's expensive, you want to save on accommodations. That is part of the reason why we think Airbnb Rooms, which is an all-new take on the original Airbnb private room, is a big option, because it's the average price per night is $67. I think a lot of people are also realizing as long as they can pay for the flight, traveling to other countries is typically a lot cheaper. For example, you can stay in Asia for a fraction of the cost per night in the average accommodation as North America. But you got to obviously get there. So as long as we can provide affordable options from accommodations, it could spur a lot more international travel.
We got to wrap. You're a busy guy. You got a lot of travels that you do as well. What keeps you up at night as the CEO of Airbnb?
I think what keeps me up at night is, we seize every opportunity in front of us. And I think right now, we have a once-in-a-generation opportunity with this revolution around AI. I think there's an opportunity for us to completely reimagine this platform and unlock the next decade of growth for Airbnb, and I don't want to miss it. If I was, running a tech company in the mid-90s, it would have been the internet, and the stock price going up or down, or like this thing happening, you wouldn't remember any of that 25 years later, but you would have remembered being at that period of time part of a technological revolution. You would have asked yourself, did we seize the moment? And that's what I'm focused on.
Well, I certainly do hope that you're still getting some good rest at the end of the day, too. CEO of Airbnb, Brian Chesky. Brian, thanks so much for taking the time.
Thank you for having me today.
Absolutely. And that does it for us here on Yahoo Finance Live. I'll see you tomorrow at 9 a.m. Here's a live shot of New York City.